Now, shall we? Macro Policy Perspectives President and Founder. Julia, great to catch up. The Chairman of the Federal Reserve in front of a House committee today. How important is that forum, just in terms of what we might hear from Chair Powell?
Well, I think it's important to keep in mind that this is not an official FOMC hearing, so this isn't the semi-annual testimony. So Chair Powell isn't speaking for the entire committee. He's speaking more for himself and for the leadership that you were just referring to. So I do think that we'll hear a very flexible tone from Chair Powell. I don't think he wants to walk back the message of the June FOMC meeting. I do think that there is greater concerns about inflation, and they want to confirm that they're willing to act if it doesn't prove transitory. At the same time, Chair Powell at his core is a labor market dove, and he repeated over and over again, even in the press conference when he was speaking for the committee, that the key lesson on the labor market is how flexible it can be, how flexible labor supply can be. And we really need to give the economy the months of reopening, several more months of reopening, before we can read the tea leaves. And he believes the labor market will come back strong.
Julia, to John's comments there on where the market is versus where the Fed is, I mean, right now, and this goes to British economics, there's a short, there's a medium, and there's a long term. In America, folks, we partition out short term and long term. Is the confusion here about the Fed and the market has one definition of short, medium, and long term, and the Fed has a different one?
Yeah, I mean, I think the market has been very impatient to jump to the conclusions about inflation and labor supply, when in fact it's going to take a long time to sort through some of the frictions of the wildest swings in demand we've ever seen. Of course, the economy is experiencing some frictions. We rebooted the global economy, so there's going to be a lot of noise and a lot of, in both directions in the data. I think it's important to remember we've been seeing surprises on inflation in one direction that can easily surprise in the other in the latter half of the year. So there's just going to be a lot of swings, and the Fed is trying very hard to carve out room for patients to interpret that friction-full recovery, reopening, before jumping to conclusions and setting a course that will turn out to be wrong.
Julia, how problematic is it for the Federal Reserve that, for whatever reason, the market did respond so strongly to a number of hawkish dots, and that the response was lower break-even rates, lower expectations for inflation over the longer term, exactly what the Fed does not want to see? How much does this actually tie the Fed's hands?
Right. So I think, yeah, exactly. The reaction in inflation was probably not exactly what they intended. The flattening of the curve was not exactly what they're shooting for. But again, they are patient. This is a few days of market reaction. I think that they want to emphasize that this isn't a more hawkish reaction function. But in fact, if they do move later, it will be because the economy is so strong. And that will be good news, that they're here to accommodate the recovery, not stop it in its tracks. So I think that may be some of the clarification that we hear from Powell through the course of the Q&A. Of course, we already have the testimony. It's very much sort of a repeat of the official opening of his press conference. So it'll be the nuances in the Q&A and how he really addresses some of the questions. Of course, lawmakers from each side will try to be pulling him over to their side. Don't we have enough fiscal? Don't we have not enough? And Chair Powell will meanwhile be, illuminating his views on the dynamics of the economy. And I think Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained, and then what we'll see is a faster and stronger recovery than we saw last time, and that's the ultimate objective here.
Julia, what would your top question be this afternoon?
My question would be around this debate on the tightness of the labor market. I think it's pretty wild to be calling a labor market with so many millions of people actively looking for work and very many millions others on the cusp of the sidelines tight. I think we know that there's some repricing in certain occupations. So I'm on camp not tight, camp we can go a lot further. But I would like to hear where Powell comes down, because I do think a question like that would get at the heart of his dovishness on the labor market and really tell us where the leadership stands on that very critical issue. If you think inflation is not going to be transitory, it's because you think the labor market is tight and we've tapped out earlier than we might hope. And there are people on the committee that do believe that. We hear that view. We heard it from President Bullard yesterday, that the labor market is much tighter than you think. A lot of these people won't come back. This is what it is. And I would try to ask Powell where he thinks the labor market is and how tight does he think it's going to be.
Julia, thank you. Got to leave it there. Julia Coronado there of Macro Policy Perspectives. Lisa, when's that? 2 Eastern this afternoon?
2 p.m. Eastern. And this will be really interesting to see if there's any kind of market response to a more dovish tilt, or whether people have basically gotten this out of their system. They're reflating the reflation trade.
Look at this bond market. These moves. 135 at the lows in yesterday's session, Tom. 159 at the highs on Thursday. That's quite a range over a couple of days.
Yeah, the dynamics are extraordinary, and you see it in spread. I took a careful look today, John, at the real yield, because I know you're going to be back Friday doing the real yield. And, you know, it's come in, but the real telltale sign here is, do we break through to a lesser negative, a higher real yield? And that really hasn't happened yet.
Your nominal yield right now, 147.51. I can see on this pillar in front of me, Tom, Dow futures made a comeback.
That's what we did.
When I was away.
Roman, thank you.
Okay.
Roman read a memo of mine.
We'll see how long that lasts. America's benchmark.
We're going to
the
embrace you, John, in the Dow.
Down not even
I'm getting you Dow pajamas.
a tenth of 1% at 42.14.
The Dow pajamas, John. They have all the old Dow members.
You get me some PJs, Tom. I'll go back to bed. How's that?
You can wear my Love Island.
From New York City. We'll talk about Love Island a little bit later, shall we, Tom? Is that making a comeback?
We shall.
You excited for that? Lovely. Good to be back Tuesday morning. Good morning. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population, but cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. Mercado Libre CEO Marcus Galperin says he sees a really enormous opportunity in fintech. He spoke exclusively to Bloomberg's Eric Schatzker last month about his company's growth prospects and opportunities in digital payments.
It's not like we need to replace the credit card system. We need to replace cash, and everybody wants to replace cash. So I think the opportunity in fintech is really enormous, and we look forward to capturing a small percentage of that really enormous opportunity in fintech.
Galperin also tells Bloomberg that he doesn't think anyone should, quote, have a considerable portion of their net worth in crypto, because it's still a very early stage and very volatile. Italy's health minister says the country will end its mandatory use of face masks in open spaces for its low-risk zones starting June 28th. Italy was the original European epicenter of the outbreak. The minister says the government will continue to follow medical expert guidelines on safety. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
There's no question that the Fed needs to go into a period of normalizing rates and normalizing the portfolio. And I think the question is really how quickly they do that and how they do that in an effort to control inflation.
That was Stephen Mnuchin there, the former U.S. Treasury Secretary, speaking at the Qatar Economic Forum just yesterday. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Farrow. Tuesday morning price action shaping up as follows on the S&P. We're down a single point, off by not even 0.1% on the S&P 500 after a really tidy snapback in yesterday's session, breaking 4 straight days of losses on the S&P 500. Outside of that, into the bond market, yields lower by a basis point, 147.51, really volatile over the last couple of days. That's for sure. Big bounce back in yields at the back end of last week, Tom. And then the big bounce back in treasuries, rather, and then yields coming back again. Can't make this one up.
You're rusty.
That's all I know.
You need a couple
just
days
trying to
here,
get
John.
there, Tom. Work out where we've been, where we're going. Get philosophical. Euro dollar 118.90, down 0.2%.
John, we do yield to 4 digits here. That's all you got to remember.
I'm trying to remember that. Where are we now?
He's giving you some
17.
Okay,
147. 1
Did you do your expenses yet?
Yields in. You know what, Tom? I haven't. I actually called Jamie last week when I got my email shut off, and I said, Jamie, can you give me an extra week? And Jamie gave me an extra week, and my expenses are about this long. I'll
little
work that out
inside
later.
baseball
Did you do the training, the internal training?
No,
get
I
that
did
done?
not.
I've got to do that too. But there you go.
Folks, it's a surveillance break exclusive. I have done all my internal training, and part of that is to leave John alone on the Dow Jones futures -10 right now. Right now, we are voting in New York. Shelley Banjo will join us here, I believe, in the next hour. She's truly expert on New York City voting and ranked choice. Right now, Martin Schenker joins us. He's Bloomberg editor-at-large and in charge of most of our visibility in Washington. Marty, I would suggest this is 56th Street, is right where we're voting key here. And this is really historic. The Industrial Arts School of New York City, a really famed school. This goes back to the fashion designer Marc Jacobs, and farther back than that, more downtown, I believe, to great Tony Bennett, who is 94 today. So that's a landmark in New York with a landmark election. Martin Schenker, Washington. This is a week where red lines will be drawn. We can start with voting rights or anything else. The power play is going to begin to sort out, isn't it?
Yeah, it's not just voting rights bill, which they need a unified Democratic Party in the Senate to get passed, and even then, you still have the filibuster. So that bill is probably dead on arrival.
Okay, but there's other bills as well.
Yeah.
And what we're talking about here is the polarity of a united Republican group, I would suggest, and then different parts of the Democratic Party. How's that? Where's that dynamic going to be in August or September?
Well, it's. I think this whole infrastructure bipartisan deal is going to tell a lot about where the politics goes from really through the rest of the Biden administration's first term. If they can get a deal, if they can figure out how to finance it without running afoul of Joe Biden's feelings about this, then I think that they can actually make some constructive progress. But, I do think it's quite possible if they can figure out how to fund it.
All right, $579 billion. We were talking about this yesterday, Marty.
Yeah.
A far cry from some of the previous proposals, and yet people are still talking about a multi-trillion-dollar fiscal stimulus from Joe Biden. What are the chances that we actually do get a significant size fiscal stimulus right now, given the emphasis on a bipartisan solution?
Well, as I just said, I do think it's quite possible if they can figure out a way to fund it, and it does look like the bipartisan group is trying. Is taking away this whole notion of an increase in the gas tax to find different ways of funding it, that they are moving towards an agreement on that. Now, $579 billion is actually not a small number, but these days it seems like that, which is pretty amazing when you think about it.
So just to dovetail, going back to what you were saying about the Voting Rights Act and the fact that Tom was mentioning that today during the New York City Democratic primary race, there's a question of whether ranked votership is going to get broader appeal beyond New York City and could even be the way of presidential elections. Is there any discussion about that? How closely are the New York races being scrutinized?
I think there's quite a bit of attention on the whole notion of ranked voting, and it's somewhat controversial. There are a lot of people who feel that, we should just vote for the person we want to be hold that office, and it's a very simple choice. I do think that a lot of people are going to go into the voting booths today and be really confused about what they're supposed to do. So you may see long lines, not because of participation, but because the amount of time it's going to take to fill in those ballots.
Marty, got to swing back to Washington with this headline just out. White House says they may invite senators to infrastructure talks. That from Punchbowl this morning. Okay, they may invite senators to infrastructure talks. Is the Biden administration doing an end around of Senate leadership and House leadership?
Well, no, as I've said a few times, I really do think Joe Biden wants a bipartisan infrastructure deal. It's not just lip service.
Is Senator Schumer in support of a bipartisan group of senators meeting with the president?
I would think that Chuck Schumer would be supportive of anything Joe Biden wants to get done. Okay. And, they can move on to the bigger stimulus later.
One final question. Did you miss John?
Oh, I absolutely did.
Yeah, I know. We were tearing up.
Thanks, Marty. Appreciate that. I believe Marty. I don't believe you, TK. Marty Schenker there, Bloomberg editor at large. Tom, since I forgot whether Treasury's rallied or sold off last week.
4 digits, John.
Yeah, I've got to catch up. Can you tell me what's going on with these infrastructure talks? Where are we?
Where we are is normal, healthy American politics. And as Mr. Schenker wisely said, the great American tradition, and this goes back to a canal in Georgetown and George Washington of a few years ago. John, this is when the colonies moved away from the motherland.
There was more that happened.
And John, it's just simple. We've argued about who's going to pay for this stuff since time began.
Lisa, I forgot that I should ask you, and I shouldn't ask you.
I don't know what you just got there. You got some kind of history there. Mayflower was brought into this. You did miss something. And this is a huge shift in tone with the infrastructure discussions, away from a headline of $1 trillion, $1.2 trillion. We're now down to $579 billion, with a question mark around whether anything else could get a follow-on from that. To me, that's a big shift. I mean, we're talking about a very big change in the headline number and, frankly, the awareness of paying for things.
John, Lisa's so fully briefed. Why don't you continue with her? I'm going to look up and see what Padres-Dodgers did last night.
Thank you, Tom. Treasury's rallied last week. Just looking at the price action now, Lisa. Probably should have done this before the show. I did. Joking. Just in case anyone takes me too seriously and thinks, why has he come back?
Yeah.
Your 10-year, 143.81 at a close on Friday. Then, Lisa, we dropped to 135 in yesterday's session. And then we bounced back to 148.86 this morning, 147. What do you make of that? Just a positioning story last week. We cleared it out, cleaned things out a little bit, cleared the decks.
People are putting faith in the positioning story as well as the global disinflationary environment. The idea that because rates are so low internationally, you see a lot more foreign flows coming into the U.S. That said, there is a dissonance between risk assets rallying and the pretty negative message on the economy that the bond markets are sending. What? Tom, you want to give us an update on the Padres?
Yeah, Dodgers 2, Padres 6. Machado just killed it. I mean, he's
good,
just
Tom.
on fire.
John's
Good stuff.
Well, there you go.
Do
John,
we do
this is
football?
baseball.
Are we still doing football?
No.
John.
No, that was I thought it was basketball.
Okay, we got to
That
do
got
soccer.
shoved
Well,
out.
we'll do soccer when we come back.
Okay.
We'll do soccer. It's called soccer.
Got
John.
excised.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
City this morning. Good morning. Here's some of the price action on the S&P after a big bounce back yesterday on the S&P 500. The cyclical parts of the market, energy, financials leading the gains. This morning, we're lower by not even 0.1% on the S&P. We're down about 2 points. On the Nasdaq, we're off by about 7. Again, down by not even 0.1%. And on the Russell there, the small caps, just a little bit softer, down 1/3%. Switch up the board and get to the bond market. 2s, 10s, and 30s in treasuries. Are we confusing just a subtle shift in the outlook from the Federal Reserve, a more balanced outlook with a shift in the reaction function? That was the take of a lot of people, confusing the former with the latter, and the latter is far more significant than the former right now. Your yield on the 10-year, 147, huge range over the last couple of days. On a 30-year, back to about 2.1%. Yields coming in a couple of basis points, just a little bit of a flatter curve in today's session at least. Let's finish on this. Dollar strength the story through G10. Euro dollar right now, euro dollar 118.91, down 0.2%, reflecting that stronger dollar story. But at 119, Tom, this isn't a massive change and a big move away from where people expect this currency pair to finish the year. In our survey, we're looking for about 122 year end. Right now, 118.90 on euro dollar.
Yeah, we'll do it later. JP Morgan really resets this morning to much weaker yen and much weaker euro against the dollar. They call it a watershed event. We'll get to that here in a moment. Right now in the equity markets, this is what is needed. Somebody with a long-term perspective who's been right about participating in the market. Steve Auth has a little bit of experience at Federated Hermes as their Chief Investment Officer for Equities, and he joins us right now. Steve, I want to look at the 12-month trailing of this unloved bull market, and it's real simple. Up 30%, up 36%, NASDAQ 100 up 40% as well. How unloved is this unloved bull market?
It's still pretty unloved, Tommy, as you know. I mean, that's sort of one of our several arguments for why we think we're in a long-term bull trend here. That you start with a base of a lot of skepticism. A lot of people got burned in 07, 08, and even the bear market back in 2000. So we've got this kind of generation just starting to come back into equities. Stocks, in our view, are actually still pretty inexpensive. We've got the S&P earnings next year. We just increase them again at $250 a share next year. So the market's not that pricey. The key risk now, I think, and I'm using a lot of the old dogs, as you kind of politely called us, we're actually happy with the Fed Powell testimony last week. Is our concern is that the Fed makes a policy error here and reacts too slowly, causes a massive bubble, and then has to really slam the brakes. The whole thing ends in tears. So I think we can prolong this recovery and the market if they just start taking their feet off the pedal here.
Okay, I want to get this. This is a really important insight for radio and television. If you take the $250 of Federated and Mr. Auth, that gets you to a present price earnings ratio of the S&P 500 of 16.84, which is a number I think a huge number of listeners and watchers don't see that we're at right now. That's where Mr. Auth says we are in a relatively cheap market. Steve, I got to rip up the script. If we get a Fed that's Authian aggressive and they tighten up here sooner or later, should we fear what equities do?
I don't think so. I mean, I know Ray Dalio was mentioning that. I think...
well, talk about that. Is Ray Dalio wrong?
Well, I think he's right to think that the risk here is that the Fed makes a mistake and waits too long. But I do think, what I think he's a little bit wrong on is, I think he's overreacting to the little bit of a pullback last week that happened when the Fed began to act. The market will always pull back initially when the Fed indicates, hey, the punch bowl might be getting withdrawn. But I think once cooler heads prevailed, I think the prevailing view, at least for me, is that if the Fed, they're not going to overreact here, clearly. I mean, they've got all these employment indicators that they're watching that are causing them to go slow. We have our whole set of dashboard of employment indicators we're watching and try to project what they're going to do next. But as long as they start doing something, even start thinking about thinking, which is what we got last week, and I kept telling my staff, just let's hope they start thinking again. And I think last week they announced that they're thinking. That's good.
Well, Steve, thank you for the update that they're thinking. I think they're talking about it. So, Steve, I think what people want to know from you, sir, is what do you want to own in this environment? Is it growth equities or the cyclicals, the banks, or big tech? Which one is it?
I want to own the cyclicals. I'm still on this trade, John, since last September. I think they're going to power higher here. They've had a nice rest. I look at all my favorite names in commodities, energy, financials. They all had pullbacks in the last few weeks of 8 to even in one case 20%. So we've had a nice little correction here in those names. The Fed is not going to kill this recovery. We've got GDP growth this year and next, very, very strong. Inflation is going to be very high this year and probably above trend next year. That's going to help those stocks. And they're still cheap if you look at them relative to where they could trade, honestly. So I see them as heading higher and leading this recovery out. The tech stocks, look, those are the long-term growth stocks. They're gonna grow their way into their earnings valuations eventually. But right now, they become almost inverse treasury yield plays. We saw that last week. That was the knee jerk when the 10-year came down into the low 140s.
Well, Steve, let's talk about that relationship between rates and what may or may not happen with the equity market. Does your cyclical call need the bond market to cooperate? Do you need higher yields?
Partly the financials for sure. I definitely need higher, a wider yield curve spread, but I certainly would help a lot to get the 10-year up to 2.5, which is where we think we're going to probably end the year. Maybe get into 3 next year, which the market can sustain that as long as we get there gradually. And you're right, the cyclical trade kind of needs those higher yields. And so if you think bonds have tapped out here, I think you do want to go long the growth stocks. We still own them in our portfolios. We never went underweight. We just took it down to neutral after being overweight a long time. But we think there's still time to get back into those names, probably 6 to 12 more months, frankly.
One thing that I was struck by in the price action over the past week is that risk assets were pretty unfazed by the idea of tapering bond purchases pretty quickly, potentially even as quickly as within 6 months if we got to that late 2022 projection from Jim Bullard. Why is that? Is there a dissonance here? Is this just basically risk assets shrugging this off and saying, not going to happen?
I don't know, Lisa. I think, there's different people have different views on this, but I think the folks with a little more experience of where we've lived through some of these big bubbles in the past, the Japan bubble in the 90s, the Southeast Asian bubble, even 73, 74, we know that the risk here is that the Fed does nothing, creates an inflationary bubble that, yes, they know they have the tools. They keep telling us they know how to deal with this, but the way to deal with that at that point is to cause a massive recession after you've already got everybody loaded up in stocks, and that's not a good outcome. So I think it's actually long-term bullish, maybe short-term choppy as we digest the idea that the Fed is going to start pulling back. I think this idea that they're introducing of late 2023 as their first Fed funds hike is probably unrealistic. But at least they're starting to talk about it. My guess is we get the first hike either late this year or early next year.
Wait, seriously? Late this year or early next year, meaning that the taper has to start sooner. The reason why I'm harping on this idea of the dissonance between bond markets and stock markets is because it seems like the bond market is not comforted by a sooner taper, by the idea of curtailing some of the froth in markets. Because frankly, the message from the bond market is a narrower yield curve, is lower long-term inflation expectations. That's the opposite of the Fed acting prudently to get ahead of inflation and not having to abruptly stop a rally and abruptly poke some bubbles. There is a question here about how long this dissonance can last, especially if you see rate hikes as soon as later this year.
Right. Well, later this year, I might have gotten a little carried away there, but let's at least say sometime in the first half of 2023, I think probably is likely.
Steve, you can't do that. You can't say later this year, then go maybe the first half of 23.
I said later this year, early next year, something like that. But later this year might be a little bit. I might have got a little excited, but certainly by later this year, being forward 6 months looking, by later this year, I think most people will digest the idea that there's going to be a hike in the first half of 2023.
Okay.
And to me, I'm always like 6 months ahead of where the puck is heading. I think that's where the market price is. So that's kind of what I'm thinking.
The puck, John, is ice hockey.
Thanks for that, Tom. Steve, I'm feeling rusty, so I'm feeling kind as well. So you run. Stephen North, Federated Hermes Chief Investment Officer for Equities. Did we settle on that, Lisa? Is it early next year, 23?
Late this year, next year. I think he's saying first half of 2023, but markets are trading ahead of that. I think. Yes, Tom?
I wasn't convinced of an entry point there. The last 10 years per year for the Standard & Poor's 500, John, 15.95% per year. I think we can round that up to 16% a year.
And Steve North has been bullish.
It's a single digit.
Through much of that bull
you
market.
Can't make money in stocks.
I'm sorry. I don't see how stocks can keep rallying if they taper within 6 months the entirety of each monthly $120 billion of purchases. John, do you buy that? That you could see risk assets continue to rally?
Not for me to buy, not for me to sell. I think it's a question worth asking. Can risk assets do well
we just get into these
with reduction of asset purchases? I'm not in a position to say whether you should buy or sell the market based on a reduction of asset purchases. Did the equity market do okay last time around? When did it really start to suffer? Really started to suffer when they started to reduce the balance sheet, when they started to push rates through what most people consider to be neutral. That's when things got really dicey in this market last time around.
John, we're making jokes about it, but like Zero Hedge features Michael Wilson over at Morgan Stanley talking about if you see an M2 reduction, he understands it's debatable and that. This goes back to Tony Dwyer. Is there a recession? No. Own stocks. That's sophisticated Dwyer analysis. Well, John, what it goes to me, and this goes to the dynamics of the market, it's the pendulum of taper.
The pendulum of taper. Look, Mike Wilson of Morgan Stanley, I think, makes a good point.
That was a theme.
Thanks,
But remember, we're not talking about the reduction of the balance sheet.
Yeah.
No,
we're talking about the reduction of monthly purchases.
The pendulum of taper was season 5, Game of Thrones, I think episode 4.
Chopping up, I've missed this.
Have you?
No. Dr. Amish Adalja, Johns Hopkins Center for House Security Senior Scholar. Your equity market down about 2 points on the S&P from New York City. For our audience worldwide, alongside Tom Keene, Lisa
That's
Abramowitz.
New York City, John. On radio, it's a beautiful, beautiful
clean streets.
This is Bloomberg.
And that's the Empire State Building.
With the First Word News, I'm Rishika Gupta. The bipartisan group of senators working on an infrastructure deal say they're getting closer to an agreement, but they say they're still trying to figure out how to pay for the plan. Considering White House opposition to indexing the gas tax to inflation, the lawmakers are set to meet White House officials today and plan to draw up a framework for a proposal this week. ExxonMobil is said to be preparing to cut some jobs at its U.S. offices, Bloomberg's learned. An evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. An NFL player, Carl Nassib, has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private, but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide among LGBTQ plus youth. Global banks like HSBC and Standard Chartered are ramping up hiring ahead of the so-called Wealth Connect link between Hong Kong and China. The plan will allow investment across the border and could open up more than $460 million in annual fees for lenders. HSBC is set to hire up to 400 people in Hong Kong, while Standard Chartered is looking at hiring or promoting 3,000 Asia wealth managers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Pretty highly vaccinated, but is also now seeing an increase in infections, and overwhelmingly these infections are the Delta variant. So this is sort of the next chapter of the COVID pandemic, and just reminds us that for every move that humans make, the virus has another one, and we just have to continue to press the case against the pandemic.
It's the never-ending pandemic with Joshua Schaffstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bramowitz, I'm Jonathan Ferro. Tuesday morning, price action as follows. Slightly positive on the S&P 500, 4214 on the S&P 500. About as exciting as I make it out to be. Yields coming in a couple of basis points, 146.83. Euro dollar with a break of 119. Some dollar strength out there through G10, Tom. 118.97. Euro dollar coming down about 0.2% of 1%.
An important conversation, John Farrell. Maybe you've got some update on this with your travels over the last 3 weeks. There's a lot of effort to open up economies. I believe I saw in Italy they're really making an effort to open up. And then in the FT 2 days ago, John Byrne Murdoch said, wait a minute, Italy's one of the biggest headaches. I'm lost. So are you. Let's get smarter. Amesh Adalja joins us now from Johns Hopkins. Dr. Adalja, which is it right now? Is it economies and societies that can open up, or because of the India Delta variant, they cannot? Which is it?
It all depends upon the state of vaccination in your country. If you are a country that's highly vaccinated, like the U.S. is, where your high-risk population, the majority of which is now vaccinated, the Delta variant is going to cause problems, but it's not going to put you into crisis. But if you're a country where there's not enough of your elderly population vaccinated, the Delta variant could put your hospitals back to where they were in the very beginning of this pandemic. So that's really what's going to gauge how the Delta variant affects a country, is how much of their population is vaccinated, especially that high-risk portion.
Is there value for Americans to study the dynamics out of England? Is there value to really looking precinct to precinct and whatever in England at how the variant's working? Does that come right over to the United States?
I do think there's value, because England is a highly vaccinated country, a country in which their high-risk population has largely been vaccinated. And what you're seeing there is the Delta variant increasing in cases, coming to dominate, but not necessarily translating into hospitals in crisis or a high level of deaths. So this is that concept I talked about before, of the decoupling of cases from hospitalizations and deaths. That's what's happening in England. That's what will happen in other places where the Delta variant appears and the high-risk population is vaccinated. So to me, I think it's very important to be aggressive with the Delta variant, but it's not something that has the capacity to put our hospitals in crisis. It's going to be a very different flavor than prior increases in cases, but it's inevitable that we'll see upticks in places where there are not enough vaccinated people.
Dr. Adalja, is the sense that the Delta variant is more virulent, that it has longer lasting implications for people who are not vaccinated? What is the distinction of the Delta?
The distinction is that it's more contagious. It seems to be more contagious than any of the other variants that we've seen, and obviously more contagious than the original version of the virus. There is some mixed data on whether or not it's more or less deadly than the other versions of this virus, but that sometimes is something that doesn't pan out when you actually look at the data. But this is something that can take off in an unvaccinated population, and that's why where we have pockets of unvaccinated individuals, it's really important for them to get vaccinated, because the more we're vaccinated in this country, the less we have to worry about the Delta variant or really any other variant.
This has been the message from health officials, business officials, and community leaders across the board. There is a question, though, of how we are recording who has gotten vaccinated and the ongoing honor system that the United States is following. Do you think the honor system is the way to go, or should there be a more formal process of tracking those who've been vaccinated and those who have not been?
Well, it's important to remember that when you get vaccinated, your state, there's an immunization registry. So that's all recorded. That's where the CDC gets its numbers. So those numbers are correct. But there's nothing on your person that you have that really tells people that you're vaccinated. You have these flimsy cards that are really not anything that can be considered an official document. I do think that this was an opportunity early on that the government should have thought about. Is there a way just to have an app on people's phone that tells them their vaccination status so people can trust it? New York State did something called the Excelsior Pass, but it really didn't take off. So I think that this is something we really should see private industry innovating to put your vaccination records in an app, not just COVID-19, but all of them. I think would be really good.
Yeah, Amish, I think a huge body of our viewers and listeners agree, Amish, with what you just said. And to me, the 2-minute drill is who's going to drive this forward. Are you telling me American Airlines is going to set public policy for America?
I do think it's probably going to come from the private sector because the Biden administration has said that they don't want to do anything like this. You might see some states do it. The International Association of Travel Agents has been working on some apps. So I do think you're going to see one of those companies come out with an app where they can verify it, and then that kind of becomes the standard.
Lisa, let's go to our other guest here this morning. Jonathan Farrell's been traveling recently. John, forget about it. You're living it. What's it like on an airplane or getting on and off where you don't know if the guy next to you is vaccinated? Full disclosure, folks, Farrell is vaccinated.
Look, I think, personally, Tom, I think it's an absolute disgrace that we still haven't sorted out the travel corridor between London and New York. I think it's ridiculous. You mentioned the private solution. I'm sure the likes of American Airlines, United, Delta would love to sort something out like that from London to New York. The fact of the matter is we're still shut down. It was really interesting to see the president go with his delegation and a bunch of journalists over to London, over to Cornwall the other week, wasn't it? And then go over to Geneva. And then we had the theatre of the mask and the elbow bumps in the UK, and then over to Geneva without a mask and the handshakes. I've got to say, Doctor, for a lot of people, it's incredibly frustrating. And I don't want to get too personal about the matter right now, but I do want your opinion on why on earth we haven't addressed this travel situation.
It's really mind-boggling. I think now with fully vaccinated individuals, they can go back to their pre-pandemic life. They should be able to travel freely without testing, without quarantine. That needs to be the standard. It's just that these countries are on different timescales, and a lot of them are reticent. Just look at Canada. They will not let Americans in that are fully vaccinated. It really makes no sense to me, and I think we have to start moving past this pandemic, this acute phase of the pandemic, because if you're why did you get fully vaccinated if you actually don't get the ability to kind of have your ability to move around the world back? So I think this is something we need to address, and I know they're working hard to figure this out, but it's going to take some time.
Doctor, got to run. Thank you. Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. That's something, Tom, that is not going to get addressed anytime soon.
John, I still can't believe we're not doing Heathrow to New York. I mean, you've been leading on this for a year and a half. Now, John, we got to go through this cycle here because I've had a lot of mail on this, and people are thrilled you're back, blah, blah, blah. We failed last week, John. We're on radio, and folks, dead silence on radio is a failure. I asked Romain Bostic about soccer, and there was complete.
Just got nothing
back. He didn't
back.
even fake it like me. I mean, Romain's just like.
Who is the failure on, Tom?
Romain is just like complete.
Yes, exactly.
Total silence. Now, John, let's go to Euro 2020. Today's a big day. The only reason Farrell's back is to go out to the Bohemian Bar, Hall, I should say, at 3 p.m. and watch Czech England and all that. But the issue, John, is the uproar. Is Harry Kane
Does he play or not?
Is he
fit?
Does
he play or not?
Well, I'm asking.
I don't know. I have to say, you know the difference between England and Italy?
Yeah.
Is that Italy always has a philosophy, a team, a strategy, and England just tries to play its best players at all times.
Exactly.
And it never works
we miss this, Lisa. We miss this. He thinks we're serious.
The pendulum of football.
Coming
John,
up, Anaheim,
you can tell when
Wells
someone's
Fargo.
fit.
Thanks, Tom. The S&P 4213 from New York City.
I think Harry Kane.
What's my out? The 56th minute.
Yeah.
Come on, we're almost there.
You got this.
There we go.
Really?
This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have many friends.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
We have an economy that's really strong. It's not normal to have rates at these low levels.
What the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
Given the rise of inflation, the hawks are more willing to show their hands.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures unchanged on the S&P 500, 42.13. A little bit later this afternoon, Tom, Chairman Powell going down to Capitol Hill to testify.
He's got a lot to say, and of course, all these different officials that we have to cover up the damage of the last number of days. And the message, John, is a time continuum. And I think really what's important with Powell is to see, is he focused on 21? No. Is he focused on 22 or even out to 23, 24? John, while you were gone in your sabbatical, David Folkert's Landau had the courage to go out to 2024, and they see higher inflation.
I'm not sure anyone's calling it a sabbatical, but thank you, Tom.
That's
okay. S&P 42.15 on the S&P 500. I'll let that go. Don't worry. You talk about the damage done to this market, Tom. What damage? Where is it?
Well, the damage, exactly. The drawdown in the S&P 500 is less than 1%. There's a lot of people saying death of the bull market. Steve Auth in the last hour, I thought was great on that. There's a raging debate. I don't know what to do with Anna Hahn here in a minute, but the bottom line is if you're not in the game, you can't play.
Yeah, and we're always focused on the dumpster fire, aren't we?
Yeah,
so
exactly.
Dumpster fire for about 5 minutes in the equity market. What happened in credit? Lisa, what happened in credit?
Absolutely nothing. Basically wide open. It was completely calm. Rallied, spreads tightened right back after a brief moment of, I wonder what's going on. When Tom talks about damage control, I have been wondering this. Where was the damage? Why aren't Fed officials cheering the response? A little bit of froth taken off the top, a bit of skepticism around how long the Fed will keep the pedal to the metal. This is a good thing for the Fed. But that said, the fact that longer-term inflation expectations came down is not good. Yeah. And if they're going to do damage control, John, that's where they're going to do it.
John, Liz Ann Saunders was just out on Twitter. 95% of SPX went up yesterday. 95%.
Damage control.
That was a jump condition sea change.
If I was concerned about one thing over at the Fed, it would be how quickly some people, and I emphasize some people, believe that the Federal Reserve had somehow shifted the reaction function on a very, very nuanced, subtle move in last week's news conference and in the summary of economic projections, and that's not what happened. And if they've spent more than a year on this, Tom, more than a year talking about this shift in this reaction function, for how people question it off the back of one news conference, one decision, that's probably not good news for them.
You know, I know we got to do data and brief and get to Anna Hahn, but one of her great themes here is the economy will deliver for Chairman Powell. That's different than a lot of other worry that's out there.
Let's turn to this market right now. 42.14 on the S&P 500. Futures largely unchanged. In a bond market, there was a rally in the Treasury market last week. 147.34 is where we are. Yields coming in about a basis point or two on a 10-year. And in foreign exchange, dollar strength the story right now. Euro dollar 118.93. Lisa down 0.2%.
Yeah, really, really dramatic market here to greet you, John. Not a lot going on. Markets trying to refine some sort of level after that drama that Tom was talking about last week. All right, today, New York City is holding their Democratic mayoral primary election. Key questions here, in addition to crime, safety, and the ranked voting, is how do the biggest cities recover from the pandemic? How do we get back to an office culture? What does that look like in a more remote working environment? Then at 1 p.m., the U.S. is planning to sell $60 billion of two-year notes. Interesting to see after yields on those securities rose to the highest level since March. If people are forecasting an early 2023 rate hike, what does that look like for the two-year, and how messy is this auction? And then at 2 p.m., the Fed Chair Jay Powell is testifying to the House. Interested to see what damage he sees to control. So sort of the discussion we were having earlier, what he emphasizes, how much he plans to emphasize transitory, and also the dispersion of views on the Federal Reserve. Should this give the market some confidence in some ways, John, that at least the Fed is recognizing the inflationary risks and they're not going to necessarily let things get over their skis and then have to come in with force, raising rates and committing a policy error?
So, Lisa, which one is it? Has the balance of risks around the outlook changed, or has the outlook changed? Is that the same thing?
The issue here is that suddenly the Fed seems more concerned about inflation, and the dual mandate between employment and inflation seem to be weighed much more heavily to employment, with the Fed basically shrugging off inflation, saying it did not pick up over the longer term. We are hearing more true concern about inflation now, and if the dual mandate more heavily weights inflation, John, all of a sudden people think the Fed is going to have a swifter reaction function and will come in and hike earlier.
Quick word, Tom.
I just think they're making it up as they go. I really take issue with all this navel gazing about, you know, what the Fed is going to do. Is that, John, they're making it up as they go.
Tom, anyone with any confidence, any conviction about the outlook here is a charlatan. Let's be clear about that.
I'm going back to, I interviewed Richard Timberlake in our Washington, D.C. office, the giant of the Georgia School, and he was just magisterial. You know what? They put their pants on one leg at a time. It looks like everybody else, and they're making it up as they go.
Talking about making
Anna
it
Hahn
up.
joins us now. Wells Fargo equity strategist.
They do. Anna puts her pants on one leg at a time. They're making it up as they
Where
go.
is this going?
TK, you want to go there. I don't. Anna, I'm going to keep things down the middle with you.
Markets.
Right? Let's get to that equity market. Anna, has anything about your outlook shifted in the last week?
There has been some shifts, especially in the last week. What you did see is that more people on the Fed are expecting a little bit of a sooner rate hike. But, you know, that move, as much as it was a bit surprising, wasn't all that mind-blowing. You saw go from 2023 to maybe a hike at 2022. That probability distribution has been pulled forward in a time frame. But that's not the biggest move to us. I think more surprising in the market was hearing taper talk start. But, you know, when is tapering actually going to begin? We don't think that's going to happen until the end of this year.
Anna, your note is brilliant. The way you dovetail GDP in is great. I've been harping on this for a week and a half. I'm putting my pants on one leg at a time, Anna. I want you to tell me right now what Jerome Powell, putting his pants on one leg at a time, what we do with 11.3% nominal GDP. Your new statistic up 7.3% plus 4% inflation. I think that math is 11.3%. Anna, that's a boom economy. Stocks go up.
Yeah, when you looked historically, you know, equities can go higher even as rates are moving higher. And that's because it's the level at which they're coming off of, where we're lifting off of. Mind you, look at where the 10-year is. But with these kind of changes to our projection, the big driver there is going to be consumer expenditure. What may be a risk to our outlook, we're keeping a very close eye on, especially with upcoming earnings, is going to be how the supply chain and inventories hold up.
Anna, you talked about the surprise of potential tapering. What would the implication be? What's the reaction of equities should the Fed start to taper their bond purchases sooner?
Well, you know they're buying $120 billion a day. And I think rather than being a crutch at this point, it's just something like we've gotten so used to it. We've come dependent on it, having that liquidity. As they taper that back, I think that risk appetite will be pared back a bit. And that's natural. When you have accommodation coming off the table, people are going to have to adjust their risk outlook and see what kind of cyclical exposure they want. But that doesn't mean necessarily it's time to head for defensives. In fact, the macro theme in play still remains reflation, recovery here. It's just a bit of a little shift, and it's different mentality than we saw from a year ago.
So if you had to own one sector into year-end, Anna, would it be the financials or would it be big tech?
I would go with financials. You know, the millennial in me still believes that tech has more upside to go. But, you know, the outperformer here, especially in the back half of this year, of the next 6 months, I put my money on banks and financials. John.
Anna, how much is this a bet on a steepening yield curve?
You know, that steepening yield curve has been, it's been a headwind for banks and financials in the last quarter. You saw what happens when the back came down. You saw what happened last week when that yield curve has been flattening. And it can be a challenge, but I think that's something that the market is going to get through. I think that's something that's going to see that trend return to a steepening yield curve, especially as you see more data come out. But one of the things we got to watch out for as well is, you know, how long is that inflation going to be marred, or when can it continue? Can the supply chain really slow it down and keep that suppressed for the next several months? I think that's going to be a part of the market we look as a signal for that.
Anna, always great. Thank you. Anna Han there of Wells Fargo. Your equity market at about 7:09 Eastern time, bouncing back a little bit, up 5-6 points on the S&P 500, advancing a little more than 1/10%. You can see the Nasdaq 100 futures here up about 1/4%. Big bounce back in the financials and energy yesterday. The bank's up by more than 2% in yesterday's session, energy up by more than 4%. And the question of the moment, Tom, really the question of the year, what do you want to own within this equity market, away from the headline benchmark, the index? Do you want to own the financials, which have done well so far, or pivot back to big growth?
Or both. I mean, and I don't have a strong belief here, John, but I do agree sector selection right now is really critical. I'd also point out, John, just in the last 4 or 5 days, moving from plus 20 down to 17.52 on the VIX right now. A VIX of 16 completely refutes the angst of the last 3 or 4 days.
17.52 right now. And Lisa, that's where the tension's been within this equity market. Will the Fed move to choke off growth? And would that shift you back towards the big growth names, the big tech names?
And will a taper actually cut off growth? I mean, that's actually something that's a big question at this point, based on your point earlier, that if they're not reducing their balance sheet, how big of an impact will this really actually have? They still are stimulating the economy by holding their balance sheet above $8 trillion.
Well, TK mentioned Mike Wilson and Morgan Stanley a little bit earlier. What's the most powerful force at play here, Lisa? The move away from peak growth, peak rate of change, so to speak, in the economy, or the move towards perhaps a tapering?
Probably the move beyond peak growth, because ultimately at this point it has to be the earnings that justify the move, and probably the liquidity in markets already is there. How quickly it will be taken out of the system remains to be seen, but earnings have to deliver,
John,
and that's what analysts say.
I strongly agree with this. I can't say enough about the linkage here into GDP. John, a research note that underscores that optimism this morning. It's a wonderful note from Paul Megacy over at JP Morgan. And John, you and I love when somebody says, you know, I was wrong. Megacy nails that now. He went weak dollar and he said it's wrong. We lost patience with a patient Fed. Our timing was poor. He goes out the yen weaker, 107 to 112. And he looks again at the real yield. John, the real yield Friday, I believe, afternoon.
Thanks. I'm just sitting here in shock that you actually did something serious for a moment. I was expecting something else.
Oh no!
Thank you.
This is serious. This is my one moment.
Up 4 on the S&P. We advance 1/10 From New York City this morning, live on TV and radio. This is Bloomberg.
I gotta brush up on Love Island.
With the First Word News, I'm Ruchika Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population. But cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. And with pandemic restrictions now being lifted across the country, companies are taking different approaches to retain staff and boost productivity. Some expect a full return to the office, while others are being a bit more flexible. Companies like Goldman Sachs and JP Morgan are requiring all vaccinated employees to be back at their desks this fall, whereas Apple and others plan a hybrid work-from-home strategy. Dating app Bumble temporarily closed this week, giving its workers, quote, a much-needed break to recover from COVID-19 burnout. In the Philippines, President Rodrigo Duterte is threatening to jail those who refuse COVID-19 vaccines. It comes as the nation ramps up inoculations to prevent the spread of the Delta variant, first identified in India. The country's Justice Secretary has countered Duterte's remarks, saying in a statement that there's no law compelling citizens to get vaccinated, and his own spokesman says vaccinations are voluntary. Several large Chinese banks are said to be restricting credit to China Evergrande Group amid mounting concerns about the developer's financial health. 3 banks with billions of dollars in combined credit exposure have reportedly decided not to renew its loans when they mature this year. In response to questions from Bloomberg, they denied lenders were curbing access to funding. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There's upside risk to inflation. Could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that, to be state contingent, to be nimble. Just as nimble coming out of the pandemic as I think we had to be going into the pandemic.
The loudest voice of the room getting all the attention, that was Jim Bullard,
Yes,
the
well
St.
said.
Louis Fed Bank president. We're catching up with the New York Fed president, Mr. Williams, a little bit later on this morning. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equities 42.17 on the S&P. We advance 0.1% there. In the bond market, yields basically unchanged, come in almost a basis point at 148. When you're buying a home in America, you might not be competing for that house with someone in the next town over. Maybe from someone out of state. You might be competing with the likes of Blackstone. Here's one for you guys. Blackstone Group agreeing to buy a company that buys and rents single-family homes in a $6 billion deal. The giant investment firm reaching a deal to acquire Home Partners of America, according to people familiar with the matter. The Wall Street Journal wrote a lovely article about this, I think back in spring, Lisa, about the competition for single-family homes in America. And your new competition, I say new, let's just say the competitor is over on Wall Street.
Yeah, the idea here that it's mass purchases, sight unseen, and they're going to come in with a bid beyond what you as an individual could potentially buy. Wall Street increasingly owning Main Street homes, raising questions about rents going forward, raising questions about affordability at a time when the average home price in major metropolitan areas rose 13.2% in the year through March, just to give you a sense of how much there has been this powerhouse behind prices
Lisa,
of homes.
Raising questions about the social warrior status of the Federal Reserve, Tom. Are these the kind of things they want to see happen? I doubt it.
I think they're going to become overcome by events on this, and it's hugely regional. There's huge dynamics here in rentals. We're all, inured to the New York City landscape where there's a real theory of rent versus buy, but a lot of other areas are different. And the crowding out thing here, John, is tangible. There's a lot of research going on about what big institutional money means for crowding out and moving up prices.
And Tom, when it comes to the Federal Reserve and the asset purchase program, I know this is just one example, but more broadly, this is a story. Do you think this puts pressure on the Fed to remove the accommodation they're providing to the mortgage market
You're
through
right,
MBS?
they should, but no, I don't think
Hold on a second. Actually, one of the main things that stemmed from last week's meeting was that the first way that they would start to taper would be to reduce their mortgage purchases, that they would actually focus the adjustment on that level. And the mortgage market has actually underperformed pretty significantly since there. So perhaps, John, exactly to your point, the Fed is taking stock of what's going on in housing.
An example of why they might have to move, Tom.
Yes.
Another example this morning, Blackstone betting $6 billion on buying and renting homes. And let's be clear here, this is not Blackstone's fault. This is the fact, Tom, that you can't get a yield anywhere else.
Oh, we'll have to see. Right now, joining us, someone who has been extremely busy within the tri-state area, and particularly the 5 boroughs of New York City. That is our New York City Bureau Chief, Shelley Banjo. She joins us too briefly here this morning. Shelley, if you were to provide a distinction today on this election, what is it? To me, it has been the ascent of crime, the ascent of what are we going to do about safety in the city. But what is the Shelley Banjo distinction of this vote today?
Thanks, Tom. It's a real vote on how you want the city to recover. So early on in the election cycle, you saw a rise of a candidate like Andrew Yang, who was saying, I want to bring hope and cheerfulness back to a city that's still in lockdown. Over the few months, everyone's kind of come out of their homes and realized, well, actually, maybe some of the more quality of life issues like crime, like trash on the streets, maybe some of those things are a little bit more important right now to me than some of the more ideological battles that were fought over the last 8 years in New York.
Shelley, Tom's been talking a lot about turnout, that typically with primaries, there isn't that big of a number of individuals that actually go out and vote. Do we have a sense of what turnout will be like this year?
I think that is the most important question that is on everybody's minds because there's so many different variables this time around. So already about 200,000 people voted early in the elections. It's hard to compare it because last time around there wasn't early voting. But during the presidential, 1.1 million people came out. That's always the case that there's more people for a presidential election, especially one like 2020. But it's really hard to know. Also, new things, ranked choice voting, a primary in June when it's usually in September. Just a whole bunch of changes this time around that make it harder to kind of figure out and game what's going to happen.
Traditionally, Shelley, New York City has been pretty progressive, and we see a roster of pretty progressive candidates. They are not in the lead, and in the lead is the issue of crime. Can you give us a sense how the increase in crime in New York City has readjusted, completely reshaped the landscape for politics in New York?
Yeah, politicians like to say that it's not just the crime numbers, but it's also the perception of crime that matters to people in New York, because if you perceive that things are bad, it doesn't really necessarily matter the numbers. You still don't want to go out and take the subway. You still don't want to go out to the museums. And so basically it's all tied together. There's no economic recovery until you get the crime rates down. There's no tourism. There's no jobs. There's no, any of those things until you get the crime rates down. And so that's why everything focused on crime, because people are looking around saying our unemployment is still double the country. We depend on tourism here. We depend on getting life back, Broadway, whatnot. And if you have shootings in Times Square, you can't do any of that. And so that's why crime really became such a hot topic during and continues to persist during this campaign.
As it should do. Shelley Banjo, thank you. Bloomberg, New York City Bureau Chief. Looking at this market, Tom, 42.18 on the S&P, pushing 42.19. We advance a little more than 1/10% in the equity market.
It's the way we're advancing, John, and this goes back to strategic notes, whether they're out 6 months or a year or they're out 6 hours. This idea of a grind higher, which you see on the Bloomberg terminal when you look across equities, bonds, currencies, commodities. I mean, just in oil, you've seen the same. This grind nature is back in vogue, particularly in equities.
That grind is back, Lisa, after a big bounce in yesterday's session.
Yeah, I'm struck by George Saravelos of Deutsche Bank. He put out a note this morning, basically talking about bond yields being low, equity prices being high, and how this basically is being back to secular stagnation 2.0, and that is what markets are currently pricing in. My question is, how far can equities continue to churn higher in secular stagnation 2.0?
Secular stagnation, 148.35. Do you think that is screaming something bad in the bond market right now? Lisa, do you think that bond market screams anything bad, anything sinister, anything to worry about?
The messaging, I think, has gotten a bit muddied, and not necessarily by the Fed's bond purchases, that certainly, but globally, the central bank's reaction function, the fact that there's so much money and that you've got foreign investors coming in because on a relative basis, the U.S. is pretty high yielding.
Are we really questioning the Fed's reaction function after last week? Is that what's been happening, Tom?
I'm not. I'm real clear on this. It's been, it's been a roller coaster coming off of the Fed show, John. 201, things just lit up, and we lit up, down, whichever series you're looking at. But the end result here are officials calming the markets. And are we going to see that?
Yeah.
I'm going to say it, John. This John Williams interview today with you and Michael McKee is without question the interview of the day. I don't know what else to say.
I think that was a sincere promo.
It was.
Of 9:30 Eastern.
No, I mean, John, this is serious stuff.
Thank you, TK.
The theoretical construct of our start is a huge deal.
From New York, this is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York, live on TV and radio, here's the price action this Tuesday morning. Good morning to you all. Equity futures advancing a little more than 0.1% on the S&P. 42.20 in sight on the S&P 500. After a nice snapback in yesterday's session following 4 straight days of declines, energy and financials leading the gains. Speaking of the banks, the financials, can you get a nice bid into the banks if the yield curve doesn't cooperate? So let's talk about the yield curve. 5 versus 30, switch up the board. A chart that topped out back in late February, just north of 160 basis points. Right now, about 121. A severe correction last week and just a small bounce in the last 24 hours. We had Steve Orth, the Federated, on a little bit earlier this morning, talking about sticking with that long bank story, but he needs the yield curve to come with him for the ride. And so far, we have not threatened to take out those highs from late February, late March. That's the bond market. Let's finish on crude. WTI and Brent. A little bit later this morning, in about 45 minutes' time, we'll catch up with Francisco Blanche of Bank of America, talking up triple-digit crude next year. $100 a barrel, maybe. Right now, TK, on Brent, 74.52. We had a little look at 75. We've come back. On WTI, 73.15 and down about 0.7% there as well. But that's the call from Bank of America. And it's a big one.
Well, it's a big call based on GDP, John. And then to be clear, 2 years out, they come back to $65 a barrel because shock, microeconomics works, supply comes on, and down comes price.
That gets your attention in the equity market, too. Let's talk about some movers and say good morning to Taylor Riggs. Hey, Taylor.
John, we tried to get Francisco on the show yesterday. They told us you stole him for the morning show, but that's really where I wanted to start. That call at $100 a barrel. Right. You have B of A, you have Trafigura, you have Goldman, sort of all making these calls of $100 a barrel is in reach. You're getting a lot of upgrades on some individual stocks, but you're not seeing the follow through as we turn unch to negative on some of the best performing stocks that we had earlier within that oil space. So let's look at a place where we are seeing some action. Norwegian Cruise Lines. This is getting an upgrade at Wolf on improving booking momentum, but that doesn't help the stock. Delta, we know that we're coming off of a really strong weekend within the travel space. They are now trying to hire about 1,000 pilots. You cannot get these people back to work fast enough. And finally, we shift to perhaps maybe some of the meme stocks. We do this just for Tom as we talk about fundamentals, trying to register an additional share sale. RBC saying that they need more cash, not enough right now for Nikola. And finally, let's take a look at MicroStrategy. What happens when you sell debt to buy Bitcoin, an average of about 37,000 a Bitcoin? Bitcoin falls to 32,000. You have a $77 million write-down, John, on the balance sheet.
Taylor, thank you. I think TK's got something to say about this.
No, just, you know, the whole Bitcoin thing. I mean, Novogratz was on with some really important comments from our Qatar Economic Forum. And John, there it is. It's critical support. A 29,000 print is a huge deal for Bitcoin.
And TK, Taylor got up early. Promo the show.
Yeah.
You going to do that?
No, I
don't
guess
fancy
so.
it?
She'll
Taylor,
be on
thank
this
you.
afternoon, probably with
the close
guests. She
starts
stole
at 2
from
p.m.,
us.
we're told. A little bit later this afternoon, every weekday.
Oh, very good, John.
There we go. All right.
Being polite.
Insert the real yield there, and it
That's
looks
the price we pay for an appearance, isn't it?
It is.
The promo.
It is.
Absolutely.
Okay,
some of our contestants stay at the Essex House. Thank you. Right now, and this is really important, this is the interview of the day that links Chairman Powell to President Biden to all the politics of this nation. If you are ever so lucky at Wellesley College long ago and far away, you studied the Cobb-Douglas production function with Carl Case, and that was a special thing. Betsy Stevenson of Wellesley and Harvard joins us now at Michigan, holding court on labor share. Betsy, labor share is a stunning trend from World War II. It's because of technology, it's because of productivity, this, that, and the other thing. Are we finally seeing a stasis or shift in labor share where they get back on board the economic pie?
Well, I mean, I don't know whether we're going to see the labor share start to climb up, but I do know that what we're starting to see is a return to workers having some bargaining power, particularly at the bottom end of the income distribution. You know, their services are in demand all over the shop. Those are those help wanted signs you're seeing. And we're telling these workers, you know, not only are your services wanted today, but they're probably going to be want it just as much or more next month. So take your time, pick your employer, start listing your demands. And they're definitely doing that. That's why we're seeing wages getting pushed up at the bottom. We're seeing people quit jobs. We saw more people quit retail jobs in the month of April than at any other time in the series history over the last 20 years. So workers definitely have some oomph in them right now, and they're using it to find a better place for themselves.
Wells Fargo was just on looking at nominal GDP over 11%, 7.3% plus like a 4% inflation rate. And I get that's an outlier call and on that. But Betsy, the bottom line is when the fiscal stimulus drifts away, when nominal GDP comes in as well, do you have a confidence that labor share increases can continue?
Well, I mean, I think that we're in the midst of a pretty great reckoning with how we've treated workers and how we've let inequality explode. I'm not at all confident that the market's going to solve that problem all on its own and that we're going to see all of a sudden a rebound of the labor share of income. I'm not confident of that. I think we're going to need policy change to actually see some permanent, real change done. But I think we are seeing what happens when we give workers some more power.
Betsy, one of the reasons why you're so brilliant, I love speaking with you about economics, is because you dovetail the human behavior into it, that basically the choices that we make determine these broad macroeconomic changes. And as we talk about the labor market shifts, what kind of fundamental changes in behavior do you observe post-pandemic about people's choices about where to work, how to work, how many hours to work? What are we seeing so far?
So, you know, normally when we come out of a recession, everybody is worried that there's not going to be enough jobs. And so when you get offered a job, you just take whatever you get because you don't know if there's going to be a job coming down the pipeline. This pandemic is completely different because we see that the economy is opening up and there's going to be job growth all over. So I think you see a lot of people being willing to take their time. That's very unusual in a recovery. But I think there's something that is deeper than that that's going on, which is we've all had a really, really weird and in many ways bad year and a half. And I think all sorts of people are stopping and asking themselves, should I be doing something different? I think that happens in everybody's life at some point, but I've never seen it happen to a nation all at once. And so we're seeing a great rethinking underway, and we're going to see that in the macro data because we're doing it as a macro group because we all had this correlated shock, which is the pandemic has caused us to question what we're doing with our lives.
And how does that sort of read through to the discretionary spending, to whether people go out to eat versus eat home the way that they have been during the pandemic? I mean, all of these types of broad macro shifts, what other lifestyle changes are you observing in the data?
Well, I think that it's too soon to see what's going to be permanent and what's not. And you're certainly seeing lots of people with things fully opening up, ready to get back out there and, party like it's 1999. But there's a bunch of people who are still nervous and people who don't want to take their masks off, people who don't want to be in crowds. And I do think that there are a lot of people who psychologically, it's just going to take a little bit to get them comfortable again being in a crowd. And that's going to change their spending preferences. Look, for sure, we're seeing people finally buying clothing again. They've got those weddings that they are going to go to this summer, so maybe they should buy something new to wear. But I don't know that we're going to go back to spending in the same way. I don't know that we'll go back to buying the same kinds of things. And certainly, I think the technology shock, really the adoption of technology shock that happened over the last year, that is for sure going to stick with us. And we're not going back to the mall, to stores, to shop in the same way. I think people are trying to figure out how much are they going to continue to do remotely versus what are they going to go back and do in person. And, almost everybody I know hasn't fully figured that out yet. They have a bunch of activities that they're continuing to do remotely that they used to do in person that they're just not ready to go back to doing in person, or maybe they don't think the value proposition is there for doing it in person. So I don't think we're seeing business travel coming zooming back anytime soon.
Betsy, we've got to go. We've got some breaking news. Got to leave it there. Thank you. Betsy Stevenson there. Getting some breaking news on Dr. Catherine Mann, formerly of Citigroup and, of course, the OECD as well. Catherine Mann being named to the Monetary Policy Committee over at the Bank of England, a 3-year term which will begin on the 1st of September 2021, Tom. The Dr. Catherine Mann replacing Gertan Vliega, who has served on the MPC since September 2015.
This is an inspired selection, John, and this goes to the Prime Minister at the G7 meetings as well. Catherine Mann, not only with her recent tenure at Citigroup, but also her academics, her profoundly important monograph, John, of a number of years ago, Is the Trade Deficit Sustainable? And then she did what is so rare in economic research. She topped it. Her definitive discussion of the codependencies of China and the United States will be of huge service to the Bank of England. This is truly an international choice for the England. You don't see this, John, at the Fed.
I think we should see a lot more of it. Chancellor Rishi Sunak of the UK saying, I'm very happy to announce the appointment of Dr. Catherine Mann. Her breadth of experience, Lisa, across policy research and the private sector will be immensely useful to the MPC.
I wonder if it was sort of tea leaves that she had a big map behind her head whenever she came on Bloomberg Surveillance, that was her backdrop, was a global map, and perhaps that's the view she brings as monetary policy becomes increasingly international.
Well, it does. Isn't that a story? We've got a more international outlook, and we need one for the Federal Reserve as well.
Well, that's what the Prime Minister says, John. I mean, the Prime Minister didn't mince words about it. He is looking for global Britain, and this is something, I'll be blunt, the United Kingdom does this better than the United States.
To attract the right
active
talent.
outside
Are you
members
just
coming
trying
in.
to make John feel comfortable?
I think he is.
No, I'm
This is
serious here.
really-
They had Adam Posen on the board.
You guys do this better than we do.
No, they had Adam Posen on the board and the rest of it.
There's a
John.
history of this, I think is what you're trying to get at, Tom.
Yeah, there is. I mean, this is really, really a big announcement for the internationalization of the Bank of England.
Is this how people make me feel comfortable? Your central bank's better than ours.
Seriously, this is flattering.
Not my
surveillance
view,
style.
because I'll be catching up with the New York Fed President, Mr. John Williams, a little bit later this morning. Michael McKee, of course, helping us lead that interview. That'll take place at 9:30 Eastern Time, there and thereabouts. Your S&P 500, 42.18 on the S&P. We advanced a little more than 0.1%. From New York City this morning, good morning, live on TV and radio. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The bipartisan group of senators working on an infrastructure deal say they're getting closer to an agreement, but they say they're still trying to figure out how to pay for the plan, considering White House opposition to indexing the gas tax to inflation. The lawmakers are set to meet White House officials today and plan to draw up a framework for a proposal this week. GameStop climbed in pre-market trading today after announcing that it completed an at-the-market offering program by selling 5 million shares for a total of more than $1.1 billion. Shares of the video game retailer surged as much as 11%, trading after the announcement. The company says it will use net proceeds from the offering for investing in growth initiatives and maintaining a strong balance sheet. Blackstone Group has agreed to buy a company that buys and rents single-family homes in a $6 billion deal, according to Dow Jones. It's a sign Wall Street believes the U.S. housing market is going to stay hot. The investment firm is said to have reached a deal to acquire Home Partners of America. That company owns more than 17,000 houses, which it rents out, and offers its tenants the chance to eventually buy. An NFL player, Kyle Nassib, has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private, but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide amongst LGBTQ+ youth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The British financial system has to do business in Asia as a whole, in China in particular, and of course that includes Hong Kong. And naturally, we don't make the laws in those countries in Asia, and certainly not in China or Hong Kong. We have to abide by the laws that are locally made, even if there are many aspects of them with which we disagree.
And apparently there are many. That was Lord Mandelson there, the Global Council Chairman, speaking to Tom Keene at the Qatar Economic Forum. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market looks like this on the S&P 500. We add a little bit of weight to the S&P, up a little more than 4 points, advancing 4 points, up almost 0.1%. Outside of that, into the FX market, euro-dollar back with a 119 handle, some dollar strength early this morning. We give some of that up. Euro-dollar now down to 119.01 and off by 0.15%. And just quickly, Tom, your 10-year back with a 149 handle. Your yield coming in just a little bit earlier on this morning again. That move kind of fades as this session grows older, back to 149.03 on a 10-year yield.
And look where the calendar is ending here in June 30, end of the second quarter, and then we begin the earnings soiree. There's no one at Bloomberg who does earnings better than David Wilson. And David, Steve Ott, the Federated, said they've done their recalibration out front of David Wilson. $250 on S&P earnings, and you fold that into price-earnings ratio to try to figure out where the market is.
Indeed, and it's something that Keith Parker at UBS did in a research report the other day, really looking at the forward price-earnings ratio on the S&P 500. So you're talking about earnings estimates 12 months out and using that as a basis for valuation, and then comparing that with what's going on in the bond market, specifically the real yield, inflation adjusted on the 10-year Treasury.
Continue.
Absolutely. So what we've seen is that the forward PE on the S&P 500 has come down because earnings estimates have been going up. That's how you get that $250 number as an example. And at the same time, if you look at the past few weeks or so, that real yield has kind of hung in there. So the way that Parker's looking at things, you know, even if you were to see that real yield move up, in other words, you know, bond yields rising and inflation adjustment as well, then, you know, stocks would be in a position to handle that.
And the only way to really understand this relationship is to watch the real yield at 2 p.m. on Friday.
1 p.m.
Oh, excuse me, 1 p.m. I'm sorry, I was thinking Nova Scotia time. You know.
Yeah, well, yeah, absolutely.
John's back, David. It's that bad.
I see that.
Yeah, I see
Welcome
that.
back, John.
Lisa, save us.
Thank you, Dave. Appreciate
Okay, honestly, Dave, there is a question implicit in your chart here, which is something that John and Tom were talking about earlier. How important is it for us to not be at peak growth, for us not to be at peak earnings acceleration in order to keep this rally going? How much does that have to continue to make the current valuations worth it?
Well, there's no doubt that it has to continue, if only because there was so much optimism kind of built into estimates at this point. You look at the second quarter for the S&P 500, we put together the individual company projections. Analysts are anticipating earnings growth of more than 60%. Now, you can argue that number is skewed because of, last year and the pandemic really affecting a whole lot of businesses. But at the same time, you look at the shift that's gone on. People going back to some extent to the areas of growth in the stock market and backing away.
So you're observing a growth tendency here, away from value?
I mean, when you look at technology, when you look at energy, there's some of that. And at the same time, look at the economically sensitive areas of the market, finance, materials, they've suffered a bit. So, the question is, does growth kind of pick up from here? And does that bear out in terms of earnings?
David Wilson, thank you so much. Greatly appreciate it. And John, that gets over to, what's going to be growthy out there. And there's different kinds of growthy as well. All this, frankly, within the social moment that we're in is wrapped around John Amazon Prime Day, I think it's called. I've never bought anything on Amazon Prime Day. I really don't get it.
Let's try and make it really simple. If the Federal Reserve moves earlier than you anticipated, and you do believe, some people do, that they might choke off growth prematurely, then growth equities become a little bit more expensive because growth becomes scarcer. That's what I think we saw last week,
But
Tom.
Anna Hahn and Steve Auth told us
they disagree.
There's another way to go here, which is, and John Writing's been great on this at Bear Stearns and at Breen Capital now, you can have a good economic and markets rate rise.
Yeah. Anna
That's
Hahn
not in the zeitgeist
wants to stick with
now.
the banks, the financials. Steve Auth, the Federated, wants to stick with the banks, the financials. Lisa, Steve Auth, though, also acknowledging that for that to develop in the way that he anticipates, he needs the bond market to come with him.
What's been shocking is that stocks have moved pretty much sideways for a while now, but the rotation under the surface, we keep talking about the various rotations, it's been pretty dramatic, and this is something that Dave Wilson actually pointed out, that over the past month, real estate has gained 6.4% in the S&P 500, materials down 5.2%. John, incredible sell-off, a sort of retracement in commodities that have been completely overblown and inflated over the past 12 months. There is a question here of how long lasting this can be. Will the Fed, for example, curtail their mortgage bond purchases and then try to take some of the wind out of the sails of real estate and give it back into other areas? So in other words, how do they nuance this in order to affect markets in a way that they see prudent?
You mentioned real estate. Should we go back to the story of the last hour from Dow Jones, that Blackstone has agreed to buy a company that buys and rents single-family homes, a $6 billion deal to acquire Home Partners of America. Lisa, this was controversial earlier this year. It's getting even more controversial as the year progresses.
And this has been a trend that has really started off in the aftermath of the 2008 housing crisis. This idea that big Wall Street firms went in and bought mom and pop Main Street homes in bulk and then rented them out. It raises a policy question about how high rents can go. It raises a question of barriers to access for the individual to really own homes, especially at a time of such low interest rates.
Well, let's talk about a policy question. TK, the Federal Reserve has been very clear about this social warrior side of their mandate that Chairman Powell increasingly has taken on. This clearly is one of the downsides of the policy, that you start to get Wall Street getting involved in home ownership in America in a much more prominent fashion.
I'm sure they would push back and say their financialization of it provides a benefit, and as they say on their website, a path to home ownership. What I would suggest, John, is they're going to focus on the mathematics of John Williams. The R-squared debate right now is front and center, and John, this comes back to the reaffirmation of potential GDP. We had Ferroli at JP Morgan tell us he stands by their low statistic, and Jan Hatzius sat in our studios, 6 days ago, and said we're going back sub 3% GDP. They're way more focused on that.
So, TK, how much daylight do you think, and I imagine you believe there's some daylight, between the likes of Bullard Kaplan and the likes of Williams?
Oh, I think there's daylight, but they're supposed to be. That's what they did in 1917 and up to McChesney Martin and the independence of the Fed. They're supposed to argue, and it's normal to be that way. You know, I think we do the world-class best interviews of central bankers worldwide and in the United States. But this interview with John Williams is going to be intense this morning. He has to re-justify their math.
Mike McKee helping to lead that interview at 9:30 Eastern, coming up a little bit later on this morning on the the Open. Coming up on this program, Binky Chada, Deutsche Bank Chief Global Strategist. Looking forward to that conversation with your S&P 500 approaching 4220 on the S&P. We advance a little more than 0.1%. Your bond market is unchanged on a 10-year maturity. Your yield is 148.86. Euro dollar back down to 118.99. From New York City, live on TV and radio for our audience worldwide. This is Bloomberg Surveillance.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Fed is not going to kill this recovery.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
Given the rise of inflation, the hawks are more willing to show their hands.
If you think inflation is not going to be transitory, it's because you think the labor market is tight
and we've tapped out earlier than we might hope.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene is simulcast. Bloomberg Radio, Bloomberg Television, and news breaking here, there, and everywhere. And John, the elephant in the room to your important interview with John Williams today. We see that in about an hour, maybe 2 hours. John, there's a Hungarian central bank wanting to raise rates. That permeates this discussion and what it means for the markets.
There's another central bank in the mix. Another headline I want to get to as well, Tom, is China selling 20,000 tons of copper from state reserves July 5th to July 6th. The copper price in London correcting just a little bit, still positive on the session, Tom, at 41.94, up on the day by a little more than 1/10 of 1%.
Well, the cross currents are there, and of course, it all comes to the volatility we see, including the Dow up 500 points. You've got to be in the markets, and our guest here to start the hour has said you've got to be in the markets. John, your observation right now with the VIX 20 in seconds into 17.42.
Look, my observation is something someone close to me recalls as kindergarten macro. Kindergarten macro is when you use last week's price action to project things out several years.
I like that.
And in the bond market, that's what we saw last week, Tom, with a big correction. Then all of a sudden, people coming out and changing their views about several years out, based on a price action of a single week and a very subtle shift from the Federal Reserve.
And, of course, a lot of Fed speak we'll get today. And, of course, we're celebrating Catherine Mann being picked up by the Bank of England as a new member. That's exciting. Lisa Abramowitz, I look at it, and you have to fold it into the bond market and the observation of that deep market. Which part of the bond market, Lisa Abramowitz, matters to you right now?
Everybody's watching the yield curve to see whether it continues to flatten or whether they get a re-steepening, a sort of acceleration in longer-term growth expectations. I do just want to build on one thing, this headline about China selling copper from its state reserves. This is the first time that China has done this in a long time, in years. And it basically is a reflection of how they are concerned that high commodity prices will curtail their recovery. This is the concern. At what point will the inflation that we've seen in commodities, in certain assets, actually hamper growth, lead to the stagflationary environment that George Saravelos of Deutsche Bank was talking about in his note this morning?
That's too much linkage for me. All I know is they're unloading a lot of copper, and we'll see from that. That's out a couple weeks, actually, that they'll do that. The market's move. The VIX comes in with a vengeance, 16.80 in a full stick right now. John, the percentage changes matter. The NASDAQ 100 leading the way, a little bit up and elevated. John, what do you see?
Looking at a bond market that's just had a huge intraday trading range over the last couple of days. Yesterday was amazing, 135 at the lows. The high is pushing 150 right now, 148.69.
Yeah, and oil, 70. John, we had a 75 print on oil.
I know.
We talked about it earlier with Bank of America
10
talking
minutes.
$100
10 minutes
a barrel.
time, Bank of America. And triple-digit crude maybe next year.
We'll see that with Francisco Blanch. Right now, and this is a joy, to bring in Vikram Chadha of Deutsche Bank, their chief global strategist. Tons to talk about in a 3-hour conversation with Binky Chadha. We'll bring it a little tight. And Binky, I want to first shout out the invention of modern Deutsche Bank strategy and economics. You guys are on fire. David Folkert's Landau is looking out 3 and 4 years to inflation. Your colleague, George Saravelos, is near term, maybe going the other way. Are you caught in the middle between DFL and Saravelos?
No, I think I wouldn't describe it as being caught in the middle. I mean, I think, if you take an issue like inflation, which we really haven't had for 50 years now, it's the most reasonable outcome is that reasonable people will have very different views, and I think that's exactly where we are. We've got a baseline view that inflation is a risk, and just that, a risk, but I think the risk, the tails are pretty fat, and I think that's the key point here.
Binky, we've had Wells Fargo on this morning, Federated on this morning, and when they are confronted the question whether you want to be long banks or big tech, they're going with the banks. Are you?
I'm long the financials and the banks. I'm also long energy. I think one of the dynamics that one needs to keep in mind over the last 18 months or so is that this is not a market that has, except for the very early part, trended very nicely. It's been a series of step functions. And so, when I look at the S&P 500 and I ask myself what's not priced in, and I would argue, it's oil prices. I would argue there's plenty of upside on, the global recovery continuing, especially if the dollar falls. Keep in mind that, you need 3% down on the trade-weighted dollar to get 10% in oil prices. So I think it's very, very reasonable that we will see $80 oil by the end of the year. And the other thing that's not priced in, and that's completely out of whack, are rates. And so you want to be long, basically, the financials. Other than that, I would be pretty careful here, and I would say, we continue basically to look for, a sizable pullback, not the mini version that we had on Friday, and that's going to hurt both the financials and energy, but we can have independent moves, oil prices and rates, simply because of where we are relative to where we can.
Well, let's build on that, Binky. You went on a tour of the asset classes there. Can that bank's call happen independent of what happens in rates, or is it dependent on what happens in rates?
I think it is dependent on rates because, if you just look at the last 18 months, financials have been trading, very, very closely with the U.S. 10-year yield. And so the pullback is in the financials relative to the market is, very easily explained by simply what's happened to the 10-year yield coming off its highs.
Binky, at the core here, there is a tension between growth and inflation, two different things that are often conflated. And we're seeing inflation as you see oil prices heading toward $80 a barrel at the end of the year, and we see it in certain commodities, which possibly is what China is responding to with selling from its strategic reserves of copper. But we're wondering how much this is asset price inflation, whether this is inflation of key goods that leads to stagflation, as your colleague George Saravellos seems to suggest. When do we have a sense of that?
I would say, stagflation clearly has two parts to it. So the first being growth. I think the key issue and point here is that, growth generally peaks, about a year into the recovery. That's kind of where we are. If you look at our house economics forecast, if you look at the consensus economics forecast, growth rates are meant to peak in the second quarter. And the stronger the second quarter is, the more likely, the sharper the peak is going to be. And I think that, there are always differences in every cycle. And the market has so far sort of diminished the peak ignored and shrugged off basically the peak growth thesis. And that's because, we have this big gap between goods and services right now. But I think anybody's investment thesis at this stage, needs to confront a very simple chart. You have a retail sales growing for 5 years, a 4% trend rate, it's nominal, purchases of goods. And if you ask, where are we today? We are 10 percentage points above the trend line. And that strongly argues for, not only slower, but very likely slow growth on the goods side. So the big question is, what's going to happen on the services side? And sure, there will be an expansion, but services don't tend to go on the other side of the trend line. And so that, on the whole, basically argues for a slow growth. On the inflation side, I would argue, this summer, yes, it is important. But remember that inflation, generally lags. So this problem's not going away. I mean, if you look at historically how inflation's behaved relative to, what people talk unemployment, the output gap, it's next year that's going to be the problem.
The great missed call of the decade or 2 decades has been the certitude of single-digit equity returns. Wrong, 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 wrong. SPX 16% per year for the last 10 years, I think. Are we going back to a single-digit structure? I mean, everyone's predicted it, and yet you and the other optimists have said, no, you got to play. You got to be in the game.
So I would keep in mind that total returns S&P 500 last 100 years, since you did bring it up, is about 11%. It's a very, very clear trend channel.
And the gloom crew is saying it's single digit.
Yeah, so I would say, given what's happened last year and this year, I mean, we have brought forward some of that return. So single digits, next few years is not unreasonable.
Binky Chandler in the studio from Deutsche Bank, the chief global strategist. The chief global strategist at Deutsche Bank is allowed about 6 feet away from TK. Yep. Lisa and I.
But this is, John, what I opened with
there.
John, what Steve Roach at Morgan Stanley did this, and DFL did this as well. Binky's writing about this intellectual diversity thing that's okay within a shop, John, to argue. Arguing is normal. Well, you say that, but Binky and I remember to when everybody, if they weren't on the same page, they were shot.
No, you can argue behind closed doors, Tom. You just can't argue.
Well,
publicly.
Steve Roach and others like David Folkers Landau said, no, we're going to do it visibly and open.
1836.
And that's great.
Coming up, Francisco Blanche, Bank of America Securities Head of Global Commodities and Derivatives Research. Just reading, it's the one thing I read, the
You're
thesis.
just going to keep going.
Yeah.
Honestly, that'll be a really interesting conversation, and I'm wondering how much pushback he has from others in Bank of America. How about that?
Triple-digit growth.
Nailed that, Lisa.
Thanks, I'm trying.
Here's the price action. I've no idea what's just happened. 42.19 on the S&P. We advance a little more than 0.1% on the S&P 500. Yields unchanged on a 10-year, 148.86. Just remarkable to see 135 at one point yesterday. Where did that come from? Then a huge unwind of that move as well.
It came before the Fed people talked.
Euro dollar 118.95.
They spoke.
And one of those
your
Fed
interview,
people,
John, your interview with
President
John Williams is going to move the market.
Your Fed person.
President Williams coming up at 9:30 Eastern. Mike McKee happened to lead that interview. Really looking forward to catching up with the New York Fed president a little bit later on Bloomberg. Live on TV and radio for our audience worldwide, pushing 42.20 on the S&P 500. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population, but cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. And India gave out more than 8.6 million vaccine doses in the last 24 hours. That's a daily record for the nation. New cases in the hard-hit country have dropped to the lowest level since March. However, less than 5% of the country's population is fully vaccinated. Some experts are warning that a third wave as the economy reopens from lockdowns. And coronavirus infections surged to a record in South Africa's industrial hub, prompting warnings about hospital capacity and calls for tighter restrictions. 1 in 4 South Africans live in the province, where Johannesburg, the country's biggest city, and Pretoria, the capital, are located. ExxonMobil is said to be preparing to cut some jobs at its U.S. offices. Bloomberg's learned an evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them within the U.S. And Netflix has signed director Steven Spielberg to a multi-year deal to create content. The streaming service secured an agreement with Spielberg's production company, Amblin Partners, in a deal that builds on an existing relationship. The two have teamed up before on last year's The Trial of Chicago 7 and another project that's currently in pre-production. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It is something where you will quite quickly, I think, run out of spare capacity as that demand recovers back to pre-pandemic levels. So, given the conditions that we are seeing, given how quickly, frankly, we've come from $35 back up to $70, up to $75, this is something that you could see in the next maybe 12 to 18 months.
That was Sandra Heem there, the Trafigura chief economist from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Tuesday morning shaping up as follows as we count you down to the opening bell. 1 hour and 12 minutes away. Your S&P 500, 42.20, there and thereabouts, advancing a little more than 1/10%. The story of the commodity market. WTI crude with a 73 handle. Brent crude had a little look at life north of $75 a barrel this morning, Tom, at 75.30. Right now, 74.58.
It is the way it has gotten there. And of course, this is all about the microeconomics and the underpinning of supply and demand. Someone expert on this and consistent in well-written thought is Francisco Blanch of Bank of America Securities, head of global commodities and derivative research. I want to go right away, Francisco, to what is less talked about, and that is the demand dynamic. What do you envision to be the demand dynamic that gets you to your acclaimed $100 a barrel?
Hey, Tom. Hey, thanks for having me. So 3 things are key here. First, there's a lot of pent-up demand. We've all been locked up in our living rooms, in my case, but really with very little movement, whether it's business or personal. There's a huge amount of pent-up demand that we're already seeing in the U.S. The rest of the world is going to join soon. Europe is maybe a couple months behind, and emerging markets are between 6 and 12 months behind the U.S. They're the big laggards, but we think they're going to come back in a huge way over the next 12 months as vaccines get distributed. Second reason, Tom, is really around what we call the avoidance of mass transit. People are going to be using more private vehicles, avoid subways and buses for an extended period of time. Third reason really is what we call the new work from home, or as we put it, work from car situation. People are going to be working remotely 1 or 2 days a week in the future, and that's going to lead to more driving, not less driving, in our view. Again, we are basing this opinion on estimates pre-pandemic and studies pre-pandemic that suggested that 1 or 2 days of work from home eventually leads to more, not less driving. Those are the three main reasons on the demand side, Tom.
Of course, on the flip side, when it comes to the demand picture, business travel not coming back as quickly, with a lot of companies saying that they are going to return to just small fractions of what they used to do. How much does that factor into your estimates?
Well, so business travel is a big factor for airlines, but let me just give you one data point. In 2019, average travel was roughly 2.3 million passengers per day going through TSA checkpoints. We are back at 2 million, and we still don't have any business travel going on. So clearly, I think the pent-up demand story seems to me is going to overwhelm the business travel story, at least over the course of the next 12 to 18 months.
Yeah.
I'm not claiming this will last forever, but I think there's going to be a huge surge here over the next few quarters.
On the flip side, the supply picture, we have this morning a story about how Russia is arguing potentially for an OPEC plus supply increase, a boost based on this increase in demand. You're starting to hear about shale producers eyeing what it would look like to bring a little bit more production online. How much do you expect that to accelerate? How does that affect the $100 a barrel call?
Right. So it certainly does. My expectation with regards to shale is that we're going to see producers lagging for the most part. Remember, there's three elements of this that on the non-OPEC side that are going to hold back supply. Number one is the fact that government policies are going to pressure companies to invest less. Right? We are seeing that with International Energy Agency calling for an end to oil and gas investments to meet Paris climate goals. Second reason is we are seeing investors pressuring companies, whether it's for financial reasons to see more cash flows coming back, or for ESG reasons to reduce investment. And the third element really is the judiciary. We now seen with the case of Shell that the judiciary can also get involved and force you legally to reduce your emissions. With regards to OPEC, it's the big risk in our call. Does OPEC discipline hold? My guess it probably will. Remember, we've only averaged $64 a barrel so far this year. The average OPEC budget is at 70. So they want to make up what they lost last year in terms of ground.
Francisco, as we speak, Bitcoin breaks down. Brad, maybe we've got an intraday chart of Bitcoin to help us out here. We've had people on Bloomberg talking up Bitcoin, its stability. Francisco, I want to cut to the chase. A grizzled pro like you, is Bitcoin linked to gold? Is there a compare and contrast, a correlation, a relationship of Bitcoin to gold?
Okay, so let me cut to the chase. You know, I put a pretty negative piece on Bitcoin back in March entitled "Bitcoin's Dirty Little Secrets," where I argued that Bitcoin had serious environmental issues, and obviously there was a big U-turn in Tesla.
China agrees with you,
and China agrees with us too, as well, of course, because they are burning a huge amount of coal to produce those Bitcoin, to mine those Bitcoin. This is my take on Bitcoin. Bitcoin, it was completely uncorrelated to other asset classes. It became more of a risk asset in the past 12 months. It was highly correlated to equities, to Mexican peso, to copper. And gold is a safe asset. It's typically correlated to 10-year treasuries, to Japanese yen. So to your question, are Bitcoin and gold linked? In a way they are, because one is a risk asset, the other one is a safe asset. So they're very different characteristics. Now, what is going to be the long run story for Bitcoin? I don't know. What I know now is that it's a risk asset and gold's a safe asset. And gold's been a safe asset for a very, very long period of time. So I'm pretty confident gold stays a safe asset. Bitcoin could keep changing, but for now, they're inversely correlated, quite inversely correlated.
Francisco, you're making such a good point, and I want to finish on this. You can have a risk-on asset and a risk-off asset, both in inflationary environments. So you can be risk-on in an inflationary environment, and the likes of Bitcoin does well, and risk-off in an inflationary environment, and the likes of gold should do well. Is that what you're saying, Francisco?
Not quite. I guess not quite what I'm saying. I mean, I'm not sure I see Bitcoin as an inflationary asset.
Okay.
I think Bitcoin, if you look at the correlations to five-year forwards, if you look at correlations to 10-year inflation, if you look at correlations to CPI, there is not much there. I think what Bitcoin is good for is that it's creating a new ecosystem of value transfer. It's creating a new economic organization based on the stakeholder economy as opposed to the shareholder economy that we have today. And again, Bitcoin is the base of that. built on Ethereum, built on the rest of other coins that are coming behind it. That's what I think is ultimately going to shape up. It's basically communities of people that transfer value using these cryptocurrencies, which is why the IRS is so interested in taxing this, because they realize there's a lot of economic activity, real economic activity, not just criminal gangs. It's also a lot of people that are actually transferring, whether it's music or videos or anything they produce via the digital asset world.
It's a good job I got you to clarify, isn't it? Francisco, thank you, sir. It's good to see you, as always. Francisco Blanch, thank you, sir, from Bank of America. It's day 2 of the Qatar Economic Forum. Right now, a conversation on the future of post-pandemic air travel with our good friend Guy Johnson and the CEOs from Boeing, Qatar Air and IAG. Bloomberg Terminal subscribers can watch on Live Go from New York City this morning with Bitcoin dropping below 30K for the first time since January. This is Bloomberg.
This morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far, but there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
from New York City for our audience worldwide, live on TV and radio. This is Bloomberg Surveillance alongside Tom Keene, Lisa Browitz. I'm Jonathan Ferro. Your equity market 60 minutes away from the opening bell, shaping up as follows. The S&P just short of 42.20 on the S&P 500. We advanced a little more than 0.1%. Yields are basically unchanged, just south of 150 at 149.37. 149.37, Tom, after a huge roller coaster of a ride over the last several sessions.
Yeah, it's been just that, a roller coaster ride, but I would just watch what happens today. And, John, that will be wrapped around Fed speak.
We'll be catching up with President Williams alongside Michael McKee at 9:30 Eastern Time. Mike joining us now for a preview of that. Mike McKee, we've had the likes of President Bullard and President Kaplan really set the stage on this. They've made a lot of noise. Mike, what's the pushback going to sound like in 60 minutes?
Well, I think we got a hint of that from John Williams yesterday when he said we're still a long way from making the substantial progress that he thinks is necessary to start changing monetary policy. The question we have for him, of course, is what constitutes substantial progress? You've got Bullard and Kaplan saying that the rapid drop in unemployment and the rise in inflation suggests that maybe we're getting close to that. Does John think we're close to it, or we still are going to be many months away?
Mike, I want to go back 10 years to John Williams putting in the research work at San Francisco on R-Star. And the paper was, have we underestimated the likelihood of severe zero-bound events? Well, 10 years on, we have lived it, Mike McKee. What is he going to say about the theory? And let's be clear, folks, Williams could win a Nobel Prize for this. There's no question about this. But Mike McKee, the path from Newt Vixel to John Maynard Keynes, and I mean seriously, to John Williams, what's he going to say of the validity of R-Star?
Well, R-Star, of course, relates to the potential growth of an economy, and his work showed that it moves around. It's not a static number. And so I think he's going to be still defending that, but there are times when you get close to the zero bound, they have said, where it doesn't really come into play. It doesn't move all that much because your interest rates are so low, and that also means your economy is not moving very quickly. So it's something to keep an eye on, is whether or not potential growth rises. Now, the Fed's forecast that they put out last week with the Survey of Economic Projections is that the economy will drop back. It will grow very quickly this year, and then it will drop back to around 1.92% 2 years from now. So R-Star doesn't move very much, and we can ask him why.
Yeah, well, there's also why the market seems to be so concerned that R-Star could move even lower should the Fed move away from their stimulus too early. And this idea that a lot of people were raising after the market response to the Fed's meeting last week, that inflation expectations over the longer term went lower. How much do you expect him to push back on that?
Well, I think he's not going to push back on the idea of lower inflation expectations, because that would mean the Fed is doing its job. If inflation expectations come down, they have the credibility that people think that they are going to act on inflation if it gets out of control. The question is, does it get out of control? Does it accelerate too fast? And both Kaplan and Bullard and Williams have all made the case that there is this big debate and there's this great uncertainty about what's going to happen. And to give you a good example of the uncertainty, you got Ray Dalio, who founded Bridgewater, saying we're going to have runaway inflation. And you've got Bob Prince, who runs Bridgewater today for Ray Dalio, saying we're not. And that's the same company.
That's what Tom likes to see play out publicly. Mike, looking forward to the conversation, and thanks for all the hard work you put into these interviews. We'll be carrying that interview on TV and radio, 9:30 Eastern Time, so TK in about 56 minutes.
Yeah, it's incredibly important interview. I can't say enough about this, folks. We partition economics. John Williams out of Berkeley, and then he went across the pond after LSE to Stanford. John Ferro, John Williams is truly one of our original academic theorists. The only one I can think of in the modern sense in Fed is Clarida.
And part of the core of the Federal Reserve, you mentioned Vice Chair Clarida along with Chair Powell, the three of them there, Tom. You're likely to hear some pushback from what we've heard from Bullard and Kaplan over the last week.
major pushback, and the huge mystery here, and this goes back again to another paper on the unknown. We get a briefing now on this to prepare for our conversation with, I say Professor Williams, Dr. Williams, with Neil Shearing of Capital Economics. Neil Shearing, from where you visit in the wonderful global economics of capital economics, do you believe in our star? Do you believe it's a countable and useful number?
Well, I believe in our star, but I think you hit the nub of the issue there. Is it a useful number? It's like all these concepts we have in economics. Output gaps is another one. They're useful theoretical concepts. Measuring them in practice is difficult. Measuring them in real time, anticipating shifts in them in real time is fraught with difficulty, and I think can lead to policy mistakes. So it's I think it falls into that bucket of analytical tools, a bit like output gaps. Like I say, useful to have, useful framework for thinking, but we have to be very careful when we then translate that into what it means for policy.
Does capital economics suggest that the Fed is making a policy error?
Well, I think again it comes back to what is the stated aims of policy, and this gets to the heart of the issue. I think with the flexible average inflation target regime is it can be interpreted in different ways by different policymakers, and we've seen that play out in the response to the FOMC meeting and subsequently last week and in subsequent days. It's being interpreted in different ways by different people. Now, if you're asking me, do I think we're going to have double-digit inflation in the US? And that constitutes a policy error? No, I don't. Do I think that core inflation is going to be allowed to run sustainably higher than 2% over the next 3 or 4 or 5 years? Yes, I think it probably will. And do I think that's a mistake? The real question is, does it then accelerate beyond that, I think? And once the inflation genie's out of the bottle, do they struggle to kind of keep it at 2, 3, 4%, or does it go beyond there? Don't forget that in the 50s and 60s, we had those types of rates for inflation, 2, 3, 4%. That was instrumental in getting government debt ratios back down after the Second World War. It wouldn't surprise me if that's what we're trying to head towards today.
Neil, there's higher than expected inflation, and then there's a question of growth. Do you think that we've reached peak growth already, or do you think that we will see it in the months to come?
We've reached peak growth, but that's really only because supersized rates of growth, turbocharged rates of growth that we had in the first quarter of this year, back end of last year, is all about the burst of activity coming back on after economies reopen. So really that's just unwinding the falls in output that we saw during the pandemic. So the US economy now on our measures is pretty much back to the same size it was before the pandemic struck. So it's no surprise that growth is really slowing, I don't think. What to my mind is interesting is what's the trend rate of growth in the economy? Has there been permanent damage to the supply potential of the US economy and other economies as a result of the pandemic? And then from there, of course, it's an easy jump to how loose should policy be allowed to run, and when does that start to generate inflation pressures? Now, the bet in the market is that there has been some permanent damage to supply potential. That's what most central banks are saying. I think that actually there hasn't been permanent damage to supply potential. You can probably allow economies to run hotter for longer before we start to generate meaningful inflation pressure.
What data points are you looking for, Neil, for some sort of compass for how to project the future here?
Well, I think there's two things I'm paying really, really close attention to. Labour markets is the obvious one when it comes to inflation. We're seeing huge friction, I think, in labour markets across the globe, particularly in the US. It was never likely that the 25 million people that lost their jobs during the pandemic in the US were going to get put back to work quickly and easily. And we're starting to see shortages appear. The question is, how quickly do those work through? So I'm looking at things like the MFIB, jobs hard to fill indices. They're I think, critical to shedding some light on how transitory or not these labour market problems are. On the other side of the world, pay close attention to what's happening to Asian exports, because they're levelling off in levels terms in recent months. There's some signs that export orders are starting to level off too, and that might be the first indication that this huge transition that we had in spending in the developed world away from services and towards goods during the pandemic is starting to unwind, and maybe that's going to start to weigh on economies in the emerging world, particularly in Asia. So they're the two things I would pay close attention to over the coming months.
Neil, I've been away from the microphone for the last couple of weeks. Tom says I'm a little bit rusty. In about 50 minutes, we'll catch up with President Williams. Can you give us a question? What's the number one for you at the moment?
Well, I think I'd be looking for some clarity really around the flexible average inflation target. How are they interpreting that? And it's all very well us saying that we're allowing inflation to run a bit hot. Exactly what does that mean? That's what I'm looking for.
We need some quantitative guidance, don't we? Neil, thank you. Neil Shearing, Capital Economics Group Chief Economist. We haven't seen that progress that some of these officials want to see, Tom. We're just not clear on how much progress they want to see.
There's massive unknown. Of course, unknown and expectations is one of the great parts of John Williams' research. And John, the unknown right now, somebody yesterday had a wonderful research note where they talked about the uncertainty right now is just off the chart. Yes, it is.
One key variable, I think, Lisa, and I think a lot of people agree as well, is the participation rate in the labour market. What happens with it over the next 12, 18 months?
And even beyond, right? I mean, we've seen a declining participation rate over the past few decades. How much does this have to do with the automation and the technological shifts? How much does this have to do with the skills or lack thereof that certain people have to fill the roles? This is a huge question. It's got some serious policy questions around it as well. I mean, I'm talking about UBI, the idea of some sort of supplemental income on a regular basis.
That's what's coming up, a conversation on the open with the Federal Reserve Bank of New York President John Williams alongside myself and Michael McKee, taking place on Bloomberg Radio and on Bloomberg TV. That's taking place in about 50 minutes time, Tom, after we've heard so much from Presidents Bullard, Presidents Kaplan. The core of the Fed begins to push back with a little bit more might.
Well, I'll agree it could be market moving, but same can be said for Czech English football. I mean, you're going to move, John, right on from your 9 o'clock hour to 3 p.m. this afternoon. Can England, leave the Euro thingy if they lose?
No. They go through to the next round regardless, I think, now.
Oh, okay.
Tom, this is about topping the group and who you play in the knockout round. Did we do a bracket? Did a bracket happen?
No, I didn't.
No, there were no brackets.
John,
that's what we're calling it.
John, if you're not here, we have no interest. 0-0, Scotland, England, ties.
Thank you, Tom. Do we still have that Simpsons
we
opening
do.
skit?
I did it out on Twitter when you were...
We should play that.
John, it's good to have you back.
Hey, TK, it's great to be back with you.
Maybe your data check tomorrow will be better.
Thank you. I'll practice tonight.
Thank you.
That was the most authentic moment of the last 3 hours.
He sits in a bar with chamomile tea and practices.
Tom Key, Lisa Abramowitz, Jonathan Ferro, live on TV and radio from New York City. This is Bloomberg Surveillance.
With the First One News, I'm Rishka Gupta. Google is facing a European Union investigation into its advertising technology. The European Commission says its case will assess whether the search giant breaches competition rules by favoring its own online display advertising technologies over rivals, according to a statement today. The probe will also look into whether Google blocks rivals' access to user data. Blackstone Group has agreed to buy a company that buys and rents single-family homes in a $6 billion deal. It's a sign Wall Street believes the U.S. housing market is going to stay hot. The investment firm is said to have reached a deal to acquire Home Partners of America. That company owns more than 17,000 houses, which it rents out and offers its tenants the chance to eventually buy. And GameStop climbed in pre-market trading today after announcing that it completed an at-the-market offering program by selling 5 million shares for a total of more than $1.1 billion. Shares of the video game retailer surged as much as 11% in pre-market trading after the announcement. The company says it will use net proceeds from the offering for investing in growth initiatives and maintaining a strong balance sheet. NFL player Carl Nassib has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private, but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide amongst LGBTQ plus youth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
doesn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
People from all around the world should be able to travel to one another's countries. And I think that is the way it will develop, but we've got to get a little less politics involved and a little more science, because these vaccines are in fact effective.
The gentleman from Boeing, David Calhoun, speaking there, their chief executive officer. This, of course, at the Qatar Economic Forum, powered by Bloomberg. We're thrilled that he could join us for those important comments. Right now, Lisa Abramowitz and I are going to have a 4-hour conversation with Barry Ritholtz, because that's how much there is to talk about. But Barry, to be honest, I got to rip it up, and I've got to look at Bitcoin, trying to find a 28,000 level. Barry, I took Bitcoin to logs, and one of my support levels is 7,000, down way below where we are right now. How do you explain to your clientele what support is on any given asset?
Well, it's a national growth rate. When we talk about equities, it's earnings and growth rate and a whole number of other factors. When we look at Bitcoin, and arguably you could make the argument, the same claim about any currency, it's just the collective delusion of what everybody agrees a currency is worth. And when I say delusion, I'm not dissing fiat currency or crypto. The fact that we can exchange little green pieces of paper with long dead presidents on it and get goods and services in exchange for it, can the crypto folks argue is also a collective delusion, albeit one backed by a standing military and a very, very robust legal enforcement mechanism to collect taxes. Crypto doesn't have that second part. And so while it certainly is a consensus sentiment trade and a momentum trade and a narrative trade, it lacks some of the teeth that traditional fiat currency has.
And this goes, Barry, to your writing, which is about how narratives have taken over the market. What's the Bitcoin narrative to Barry Ritholtz?
Well, the Bitcoin narrative is the great financial crisis led to a massive group of ill-advised government interventions. Since then, central banks around the world have been printing. I love the meme, printer goes brr. And therefore, all of these fiat currencies are going to become worthless. Your choice is either buy crypto and drive Lambos, or hold on to your fiat currency, which will soon be worthless. And P.S., as a public service, I like to tell people, send me all of your worthless U.S. fiat currency, and I promise to dispose of it properly.
Well, Barry, there's another narrative that actually has gained some steam among the hedge fund industry, among institutional investors, the likes of Troy Gajewski of Skybridge coming on and saying that it's actually the determining factor in your outperformance, because it's a macro bet on the basically worthlessness, increasing worthlessness of fiat currency, but also the money printing that we've seen, the money printer go burr. And there's a question of whether there are forced sales or whether that narrative gets reversed when you start seeing Bitcoin have its worst two-day plunge since March of 2020. And when you start looking at levels that we saw 50% below the highs this year.
Right. So in the battle between China and Elon Musk, China is winning, at least when it comes to crypto. But, here's the way I really think about Bitcoin and the rest of the blockchain universe, which is something complete. The technology is very different than the tradable asset. Bitcoin was about $1 trillion and change, smaller than Microsoft, Apple, bigger than Home Depot or Chase. And so it captures an immense amount of mind share. But if you think of this as a really successful company who's had a great run up in stock, its stock price puts it in a little different context. I think there's been the fear of missing out on the next new thing. A lot of people plowed into this maybe a little late, and watching anything get cut in half is always painful if you're long and wrong, especially if you were anywhere near the top of that. But I don't think we would talk about Bitcoin the same way if we really thought of this as like an individual company. Now, lots of folks are forecasting Tesla going to 5,000 and Bitcoin going to 100,000. And there are all these crazy forecasts. And for the most part, those wild outliers don't work well for investors. But keep in mind, this has yet to come up with a solid use function. Hold aside, kidnapping and ransomware and other illegalities. We're still waiting for the use case for this. There are lots of signs that blockchain is going to do some really interesting things, but it has yet, after 15 years, it has yet to really change the nature of our financial economy.
Barry, we're out of time. Thanks. Wonderful to catch you here with Bitcoin 30,000 down to 29 level. We're looking for 28,000. We're not there yet as well. Mr. Ritholtz writing for Bloomberg Opinion. Lisa, I guess we could sit on Bitcoin, but let's get back to the rest of the market right now. And I'm sorry, it is about Fed speak, and this interview with Dr. Williams of the New York Fed is a big deal.
Right now, you're seeing a reflation of the reflation trade, at least when you take a look on the margins at bond markets. Interesting to see that equities are kind of range bound here. But yes, very much looking to see what Fed Chair Jay Powell tries to walk back from the more hawkish tone that the central bank gave off last week. Again, Tom, they shouldn't be that unhappy with the reaction. It was not some sort of taper tantrum. There wasn't a disproportionate response. But there are some concerns that are sort of baked into the market response, and that is a decline in longer-term inflation expectations.
You bring up a really important point. And folks, the way I gauge the pendulum of taper is to look at the VIX. And, I know it's hackneyed, but the fact is I look at the VIX, and it got out 2021 level. I haven't even looked. I don't have time to look now, Lisa, because I'm watching BitDog. But the bottom line is the VIX didn't get out to 30.
Yeah.
It didn't get out to 42, and that's your tantrum.
Yeah, right now it's 1769, just to give you a sense of where we are. But you saw the exact same kind of muted action in the implied volatility in Treasury yields, the MOVE index of Bank of America Merrill Lynch. Also not showing a huge spike up in implied volatility going forward. This should be a positive for the Fed. This should give them confidence that they can start to signal possibly tapering or raising rates, save for the inflation expectations. And that, I think, is really the sort of the needle they have to thread right now.
Well, this is a headline that we've got to bring to you because this will be the talk of global Wall Street, and we'd like to be the talk of global Wall Street. A small German bank has a minority investor with a great interest because their minority investment is a great investment. That would be from Qatar. And I'm not sure this is at the Bloomberg Forum, but I would say, Lisa, Deutsche Bank's top Qatari holder says time is right for mergers.
Yeah.
I've never seen that headline before.
No, and this sort of speaks to the consolidation among the European banking system that people have been calling for.
The initial catalyst. The news flow is actually quite extraordinary.
Yeah, it's picking up.
John Williams with our Michael McKee and our John Farrell. Look for that. That's an important interview. Futures, well, we've gone a little fractionally red. It's an optimistic red on the screen.
Optimistic.
Stay with us. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. From New York City for our audience worldwide, good morning, good morning. 30 minutes away from the opening bell in New York City this morning with futures totally unchanged and counting down to testimony from Chairman Powell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
From New York, we begin with the big issue. Markets turning to Chair Powell for clarity.
Market players need to focus on what matters. Chair Powell. What matters is what comes out of Powell's mouth.
Is the Fed actually committed to average inflation targeting?
The market was looking for an excuse to unwind a lot of crowded trades.
Market participants have to tune out the white noise.
I don't think he wants to walk back the message of the June FOMC meeting.
I don't think the story has necessarily changed. The tapering discussion and the liftoff discussion is just an adjustment in timing.
Getting the market to realize that they won't just let inflation run forever.
It was totally naive to ever think that the Fed was going to let inflation get out of control.
What's happening is just a repricing of the pace of the tightening.
Reprice this hawkish outcome.
We are moving away from super easy policy.
Joining us now, Priya Misra of TD Securities and Tom Titsouris of Strategas. Priya, I want to start with a basic one. Are we confusing a shift in the outlook with a shift in the reaction function?
Exactly. I think that's sort of what's happened. I think the market saw the dot plot and saw unchanged economic forecasts and said this is a shift in the reaction function. It's a more hawkish reaction function. It's a policy mistake. We literally went from the market saying that the Fed is behind the curve on inflation to the Fed is ahead of the curve and they're going to trigger a recession. I think this was really a case of positioning the big reflation trade, unwind, and then trying to find a narrative to fit price action. I think the Fed, in my mind, this was a risk management approach. They tried to get the narrative back to saying, no, we won't let inflation run out of control. I think that's what we'll be watching from Fed officials, that they are more optimistic about the outlook. They have probably more confidence in the outlook. They probably see an upside risk. And then in that scenario, they can withdraw accommodation without the market going through a tantrum. I think that's what I'll be watching from Chair Powell, that the commitment to the average inflation targeting, that is not wavering, that they are not suddenly terrified about inflation running out of control.
Tom, you heard the basic argument there. We're confusing a shift in the outlook with a shift in the reaction function. Do you agree with that, Tom?
Yeah, I think I would even go so far as to say it's really a shift in the communication. The outlook hasn't really changed, in my opinion. I do believe that most Fed voters, if you would ask them in private, do you really think you can hold off till tightening until, say, 2024? They would have said no. I think they're just communicating now what we all see, that the U.S. economy is improving. And so there's really no change in the reaction function or the policy. It's just a change in the communication. But with that said, there's three things that I would be concerned about if I were Fed Chair Powell. And those things would make me want to do a little bit of a walking back of what was discussed last week. Those three things are that the dollar was up about, we'll call it round up 2% from just this change in communication. You also saw, even though the Fed dots pulled forward rate hike expectations to 2023, and two of them in 2023, the market also pulled forward its own rate hike expectations, which continues to be well ahead of the Fed. So the market went from roughly December 2022 to June 2022, really a serious overreaction to what the Fed is saying. And then last but not least, that curve continues to flatten. And we're always concerned about flattening yield curves. And we think anything below 100 basis point 2s, 10s is a very clear warning sign to Powell, and we think Powell was aware of that as well.
Right now, 2s, 10s at 126. Chairman Powell going in front of a House committee today. In the testimony, sticking to script, he says the following: inflation has increased notably in recent months. As transitory supply effects abate, inflation is expected to drop back towards our longer run goal. Looking at this a little bit later today, Michael McKee, our international economics and policy correspondent. Mike, good morning.
Good morning, John. I think that Tom nailed it. It is a communications challenge for the Fed chairman today. because there are 18 members of the Open Market Committee, and it is clear the economy is growing faster, inflation is rising faster than their forecasts a couple of months ago. But they want you to know that they're still on the job and it hasn't changed much. The problem for the Fed is that while we're not getting a taper tantrum yet, the baby is rattling the crib. And they need to make sure that people are reassured that they are not going to let inflation get out of control, or that they are not going to choke off the recovery. And that's a communications issue. You have some Fed officials who are at this point out ahead of the others in terms of we should talk about tapering, but they haven't called for tapering yet, and that leaves a sort of a vacuum out there. The Fed leadership, Chairman Powell, John Williams, who will be with us in a few moments, talking about we're not close to that yet. So for Powell today, it's kind of let's square the circle. Let's try to bring people back to the center point and not have them worry so much about what we're going to do.
That interview with Mr. Williams, President Williams of the New York Fed, Mike, taking place in about 25 minutes' time. Michael McKee happened to me to lead that interview. A little bit later, 9:30 Eastern Time, the New York Fed President John Williams with Michael McKee and myself. Priya, I want to turn back to you. Mike said it, Tom said it, communication issue. Wasn't even a shift in the outlook, it was a shift in the balance of risks around the outlook, and it engineered just a massive repricing in the Treasury market, Priya. What did that tell you?
So I think that tells you that positioning was extremely crowded. The reflation trade has been the winning trade really since late last year. Since we got the vaccine news, we saw the flexible average inflation targeting regime being unveiled. These trades have worked for almost a year. I think there was a massive exit. But I do think, you know, there's a couple of issues here. The committee is a little divided. I think there are members on the committee who think that the Fed should be probably tapering soon and hiking next year. Meanwhile, others don't. So we've got a divided committee, which makes communication a challenge. I also think the Fed is trying to retain flexibility, which is a good thing. But when you've got data which is hard to read, data is extremely noisy. I think the data is going to be reopening impacted all the way from now until the end of September. So how does the Fed, that flexibility which can work for them in terms of discretionary policy, can actually create more of that communication challenge? Because what if we get 1 million payrolls next week, in a holiday shortened week? You know, does the market then say, wow, tapering would be announced in Jackson Hole, and the Fed really wants to retain that flexibility? So it is a communication challenge, but I think if we hear clear commitment to the FAIT policy is still there, that this is a risk management exercise rather than a reaction function shift, I think it'll come, and I think positioning is much cleaner. So we actually put on steepeners yesterday, were short duration. I think the reflation trade unwound almost too much.
You're back on a steepener. Priya, right now, 2s, 10s, 126. What are you looking for?
Well, we have more of a 530 steepener because that, you know, the very front end is extremely anchored. If the Fed is not hiking for another 2-3 years, we think it's only late 2023, then that 5 year is going to be extremely anchored. And the market, I would agree with Tom, has moved the first hike into late next year, which is way too early. They have to first communicate a tapering well in advance. Then they have to finish tapering, which is, in our view, a 10, 11-month process, and then hike. So we're talking about 2023 on hike. So I'm looking for 530s to go back to 150, 170, significantly steeper than here.
530s right now, 126. They peaked at about 160-ish back in late February. And Tom, my question would be, before we even had this shift in the balance of risk around the outlook, not the reaction function, the shift in the balance of risk around the outlook from the Federal Reserve, we already topped out on a 10-year nominal yield at the end of March. We already topped out in parts of this yield curve at the end of February, end of March. What's to say that we don't get mid to late cycle dynamics start to grip this Treasury market before these guys even hike?
Well, if that's the case, then they shouldn't be talking about hiking. Because simply put, if this curve can't steepen out to 200 basis points, 2s, 10s, then that would be a very clear warning sign to me that the bond market is saying there's not enough long-term sustainable nominal growth for them to be considering tightening anytime before 2023. And I think that's important. But I think another important point here is that the bond market, I absolutely agree with Priya's comments earlier. The bond market is basically looking through the tapering issue here and also overpricing the risk of tightening. So we think basically here the curve has got to steepen back out as the Fed is going to shift more of its communication towards tapering as the primary exit mechanism in the early going versus tightening. And that should be a catalyst for steepening.
Are you comfortable positioning for that now, Tom?
Absolutely. So we still forecast a 2s 10 spread. We like to focus on 2s 10s, but this would certainly be analogous to 5s 30s as well. We forecast a 2s 10 spread of about 170 by the end of this year. So we still see 50 basis points of steepening. And we do see a treasury market in the notes part of the curve, we'll call it the 5, 7, 10-year part of the curve, that is looking overbought to us right now.
Let me put you both on the spot and finish on this one, just in this part of the conversation. Do you think tapering is a dynamic that leads to higher or lower long-end yields, Priya? Which one is it?
I think it's higher. And this is because I think the Fed is not in a rush to taper. They want to be absolutely sure that the COVID impacts on the economy are sort of, we've made substantial progress as they've put it. So I think real rates can start to rise while keeping inflation expectations and risk premium unchanged. So as those real rates rise, we have a $3 trillion deficit, tons of, there are auctions of 3 weeks in a month. We have to find a marginal buyer, private market buyer of treasuries, I think that puts upward pressure on real rates in the long end, while break-evens can stay unchanged, and that can actually make nominal rates rise. So I would argue it's higher rates.
Tom, just quickly, same question to you.
Yeah, absolutely agree, 100%. I hate to say this time is different, but what made it the situation in the last decade so that tapering led to eventually lower yields was because you had a fragile economy and you really could not sustain much higher real interest rates without pushing break-even inflations lower. This time you see a much more robust and expanding economy. So for the time being, we can push real rates drastically higher and presume that break-even inflations are going to stay stable. And so therefore tapering should this time lead to higher interest rates, whereas that was not the playbook in the last decade.
Tom, Priya, on this bond market ahead of Chairman Powell a little bit later this afternoon, 149.90 on a 10-year, just south of 150 on a 30-year, 214. Need to get you some stock moves as well in this equity market ahead of the opening bell. Here's Abby.
John, let's start out with Bitcoin because we, of course, have Bitcoin flipping above and below $30,000 per Bitcoin, dropping below that $30,000 mark for the first time since January, now down more than 50% from its all-time high. China recently really cracking down, but perhaps you can also bring the Fed into this conversation, that extra liquidity, seeking a home too far, too fast, maybe for not a good reason. So, of course, Bitcoin getting hit and right now back below $30,000 per Bitcoin. Not surprisingly, hitting the crypto space. Lots of the crypto movers down sharply, including Coinbase, which is now 10% below its direct listing pricing. And then finally, to bring some positive news into the report here, let's take a look at some movers to the upside. GameStop up 7.3%, popping on a $1.1 billion at-the-market stock sale. Sanderson Farms, the egg producer, exploring a sale. JP Morgan saying this company, the shares worth $200 within a sale, so some upside potential there potentially. And then Splunk up 9% on a $1 billion investment from Silver Lake. John.
There we go. Abby, thank you. Equity futures unchanged. Coming up, White House officials heading to Capitol Hill for another round of infrastructure talks. That conversation up next with TD's Priya Misra and Tom Titsouris of Strategas from New York City with about 18 minutes to go until the opening bell. Equity futures on the S&P marginally higher, 20 minutes away from catching up with President Williams of New York. From New York, this is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The president has proposed a range of ways to pay for this package, including ways that would not violate the red lines the Republicans have put forward. The president's pledge was not to raise taxes on Americans making less than $400,000 a year. And the proposed gas tax or vehicle mileage tax would do exactly that. So that is a non-starter for him.
Infrastructure talks stalling with partisan sticking points blocking progress. Negotiations continuing on the Hill today with a group of senators efforting a compromise ahead of the July 4th recess. Senator Mitt Romney striking an optimistic tone, saying, quote, "There are a number of pay-fors that we've been able to add to the list, and I think we're going to get there." For more, let's bring in Bloomberg's Emily Wilkins. Morning, Emily.
Morning, Jonathan. Yeah, we are hearing a lot of optimism from senators on the Hill, both Democrats and Republicans, saying that they think that they can get to yes on this. Key question is, what does President Biden think? His advisors are heading up to the White House, to the Congress today, rather, to meet with senators and discuss the plan. Big sticking point right now is the pay-fors. How does this get paid? Where does the money come from? Senators have put forward the idea of a gas tax. President Biden said, no way. That offer now seems to be off the table. What President Biden would like to see was a bolstering of the IRS, which would allow it to really do more thorough audits of companies and wealthier individuals. That's something that the president has put forward. It hasn't gotten a very warm reception from the senators yet. But at the same point, President Biden is still under increasing pressure from progressives in his party to go ahead and move on their own. You have Democrats in the Senate putting together a $6 trillion package, which includes infrastructure, child care, child tax credit, and that is being ready to move should these bipartisan negotiations fall apart. At this point, there is a lot of questions about whether some Democratic senators would sign on to this bipartisan package. Some have said that they would not, and that will cause issues in getting this through. So a lot of things to negotiate, and we're coming up on a 2-week recess this Friday. Senate, House, they leave town, and that makes it even longer of a time frame to actually get something done.
Emily, I dislike the concept of deadlines. I was told it was days, not weeks. That was 3 weeks ago. I've been away, and seemingly we're in the same position. What exactly is going to guide this administration as to whether they should move away and go it alone?
The Biden administration is trying to balance two things here. Number one, President Biden ran as a bipartisan president. He thinks that that is key to the Democrats being able to keep their majority in 2022. But at the same point, Democrats have said, look, we need to pass a big package. We need to meet the needs of voters. I think one key thing to really look for today, Jonathan, is there an agreement on the pay-fors? And is there an agreement that if they do move with this bipartisan package, there can be another Democrat-only package that can hit on some of those other Biden administration initiatives. If those things can be done, the path forward for a bipartisan deal looks better.
Emily Wilkins down in D.C. Emily, thank you. Just how important is the outlook for the next fiscal step for this market? This was Peter Cheer of Academy Securities, who wrote the following: much of what is driving the market can be linked to doubt about the size and effectiveness of fiscal stimulus. Less fiscal stimulus would reduce future bond supply and at the same time reduce growth prospects. This increasing concern, or the lack thereof, will act as a headwind for markets. Some final thoughts now with TD's Priya Misra and Tom Titsouris of Strategas. Now, both of you are on the same page around the direction of the yield curve. You both want a position for a steeper curve. Now, Priya, is that dependent on or independent of what happens in Washington?
So we are looking for a pretty big package to pass, so that would certainly help the steepener in my mind. I don't think the market's pricing in this deal. I mean, they've been back and forth whether they'll get. We've just seen it's a bit like world peace. We all wanted. The details are where everyone gets stuck. So I don't think the market has priced it in. And if it does look likely that the Democrats are going alone, I don't think it has much of a Treasury supply implication, because I think there will be pay-fors, there will be the tax increases. The issue is it positive for growth in the long term? Does it mean that the Fed terminal rate, which has actually declined, market's only pricing in the end point of the hiking cycle at 1.5%, in 3 years, does that move higher? Because infrastructure should help productivity, should help long-term growth potential. I think it puts upward bias to rates if it passes. But I would say it's not really in the market's mind right now. I think we just see how difficult it is to get any bipartisan agreement, done anytime soon.
Yeah, Tom, I'd like to put the same question to you as well. You, like Priya, positioning for a steeper yield curve. Is it dependent on or independent of what happens in Washington?
Yeah, it's absolutely dependent on what happens in Washington. And I'd even go one step further and say the fiscal picture could be one major qualifier in our view for a steeper curve, because it really does depend on how you pay for that, that fiscal spending plan. So let's just really quickly look at what infrastructure spending does. Infrastructure spending boosts growth as well as productivity, but here's the catch. How many shovel-ready projects are there in the U.S. right now? Probably not enough that we could boost growth now. More likely what we'll see is a great backlog of different projects in different phases of planning cycle, which could mean that you get a growth boost sometime in the middle portion of this decade. So that's important because you have supply coming in, yes, but if you're going to pay for this infrastructure spending with a round of tax increases, particularly income tax increases that hit, we'll say, I don't know, January 1st, then you have immediate fiscal drag, which the bond market has to consider. So it's a real big question mark. And in my opinion, it's probably the biggest question mark right now, aside from Fed Chair Powell's status as Fed Chairman in the next year. Those are the two big question marks the bond market has to deal with. And right now, I think it's a coin toss whether or not we have pay-fors or this is debt financed, and if the pay-fors are so restrictive themselves that they actually create substantial fiscal drag next year. And that's one of the things I do think the bond market is kind of tussling with and doesn't know the answer as of right now.
You mentioned a second dynamic, so let's finish there, Tom. The prospect of a second term or not for Chairman Powell. Why is that so important when we've just had this huge shift in the framework, the reaction function of the Federal Reserve? Surely that endures whether Chairman Powell sits there for another term or not.
Yeah, my opinion is the bond market in particular is going to see through any removal of Powell as entirely a political decision. And when you consider the enormous respect the markets have for Powell, and not just the markets, but other central bankers, this is different from Bernanke in 2013 when the market was really not, the economy really wasn't growing. And so there really wasn't a lot of pressure on treasuries. This time around, there could be a lot of pressure on treasuries and the dollar. And so removal of Powell would be interpreted, in my view, would be interpreted as a political decision. And this would be the absolute worst time to be making Powell a political casualty when he has so much respect to the markets. And it's such a critical time for U.S. monetary policy.
Priya, why is that different to what we saw from Yellen to Powell?
Sure. So I think there has been this framework review, and it's a new policy. It's untested. And I think that's creating some question in the market's mind that if you have a change in leadership, and it's not just Chair Powell, it's also Vice Chair Clarida. There's a bunch of changes at the committee. I think the question will be who's next? And is it considered a political appointee, in which case the market starts to lose some faith in the independence of the Fed? And I think that's a problem, particularly for long and inflation expectations. But, if it is Governor Brainerd or somebody else, who seems to be very much in line with Fed Chair Powell, I think then the market can actually look through this as just being a political shift.
Or New York Fed President John Williams, who will be joining us in about 10 minutes' time. Priya, we've got to leave it there. Priya Misra, Tom Titsouras. Guys, great to catch up. Appreciate it, as always. Coming up, the morning calls, and later, the reflation trade in focus on the heels of the Fed's very, very subtle pivot in the last week or so. Still ahead, Tor Backen's Michael Purvis, plus our exclusive conversation with the New York Fed President John Williams and Michael McKee helping to lead that conversation from New York. This is Bloomberg.
now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Minutes away from the opening bell in New York City. Futures price action pretty muted, unchanged on the S&P. Some underperformance on the Russell, down by about 0.25%. That's the price action. Here are the morning calls. First up, we begin with Raymond James, raising its price target on Nvidia to a street high 900. The analyst calling the company best positioned for long-term growth. Next up, Stifel, upgrading CrowdStrike with a street high $300 price target, citing improving customer demand trends and a likely path to expanding margins. And finally, Cowen naming Lionsgate Entertainment a best idea. The analyst highlighting the company's success with streaming video. That stock up by a little more than 2%. Coming up, Michael Purvis of Toolback, and plus an exclusive conversation with New York Fed President John Williams and Michael McKee from New York City. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! All the world is possible!